you hear me? Hello, Yafeng.
All right. Hey guys, can you hear me?
Yes.
Oh, hello. Andy, hello.
Hello.
Yeah, I can hear you, I think. Cool. So it's great to be back in California after spending the week in Dallas. Definitely some good perspective. But yeah, happy to be back. I'm actually I'm dialing in from home because I'm working from home today. So no camera.
Okay.
But let's go ahead and get caught up. So lots of things have been happening over the past, week, past 7 days since I've been gone.
Yeah.
Some big things on the macro side that we're seeing, which is causing this big rotation. It's also, we also started earnings season, so a lot of companies are going to report, and it's just a really interesting time. Let's go ahead and kick off by talking briefly about macro. So, today we had the GDP data come in. We saw that GDP came in on an annualized basis, quarter over quarter, at 2.8%, which was quite above the survey of 2%. So that was something important. We also had durable goods orders come in, which was very soft, negative 6.6%. Jobless claims came in roughly about in line with the survey. But another thing is, Kansas City, the Kansas City survey that came in very weak too. So, a lot to unpack on the economics front. From a market standpoint, the bond market sold off, or sorry, yields came in, so it actually was bid up. Yields came up, and we saw kind of a reversal of what we saw yesterday. Yesterday we saw a bit of a steepening. Today we saw greater or a deeper burdening or flattening in the curve. In addition to that, we had oil up small, industrial metals were kind of mixed, but I think that's kind of the backdrop for where we are. So let's go ahead and talk this. Yeah, fine. Andy, what do you guys think about what's happening?
First.
Yeah. Andy, you can go.
You can go.
Yeah. So like the GDP just went.
Hey, I think your mic is super low.
Hello.
There we go. Yeah.
All right. I mean, I'm just saying like the GDP is like it's like 2.8%. Yeah, I think that went like pretty close to like the GDP now estimates. So from on Friday, like the nowcast will be tracking the Q3. So like this is like the advanced estimate. So that's like the first print. So yeah, I'm just like looking at the table. Yeah, like the personal consumption, the PCE went up like 2.3%. So that means like the consumer is like pretty strong still, at least like for the first print. Uh, Private domestic investment went up like 8.4%. Yeah, like the residential like went a little bit like negative. Residential investment. I mean that kind of like matches the home sales data has been like weak for almost like 3 or 4 months already. So I mean that's kind of like expected. Um, yeah, I mean overall just like it seems like the consumption is like still strong. I think that's kind of like uh it's like kind of like uh undermine our like previous thesis a little bit. We're thinking like the consumption is like getting weaker, but I think just like this is like for the past quarter. I mean, that's kind of like uh, like so that's like in the past. So I'm not sure like if like starting from Q3, then we're probably gonna see some weakening. But like for now, like everything went strong. I think the yield market, like the rate market, kind of like uh, resonate with this as well. Like today, we saw like a pretty significant flattening, like the two-year went like the yield went up, but like the longer end like went down. Um, yeah, I mean, like as for the durable goods, I mean, the headline looks pretty scary, and it's like negative 6.6 for new orders, but those are due to very volatile components from the let me see. Uh, like here, I saw like the transportation equipment is like negative like 20%, and non-defense aircraft and parts, like the new order is like negative 127.2%. How? Wow. I mean, yeah, but overall, like the part that really matters, which is the let me see. Yeah, it's like the core capital, like non-defense capital goods orders ex aircraft is still like jump by it's growing by like 1.0%. Like yeah, I mean that means like if we just like excluding the very volatile transportation and like aircraft orders, overall I think the equipment investment is still I mean just like the core looks still okay. Um, yeah, I mean, overall, I think this, like the stronger like GDP print. I mean, although it's like in the past, it kind of like raised the baseline of like the for the future quarters. So I think that's why kind of like the rate market is uh starting to reflecting like probably like a more hawkish outcome for like the next week. I mean, like the 2 year is kind of like the proxy for the policy decisions, and seeing like 2 years, like the yield is coming up to today is kind of like, I mean, that's kind of like a hawkish tint, basically. Yeah, so like tomorrow we got like the inflation data, like the month over month core PCE. I think that will provide like further information. So now we have like the growth aspect. It's still like we have like a very decent growth in the economy. So tomorrow we'll see like the inflation is kind of like rebounding a little bit, or is like the disinflation path is still intact. Um, yeah, yeah. I mean, this is like what I have for now for the U.S. side.
That's a good context area, I think. Um, yeah, I think my read when I looked at the GDP data, it definitely came in a bit better than I expected. But I did expect that the first two quarters of the year were going to be above trend.
Right.
So our view is for the next 2 quarters to come to average at around 1% for the next 2 quarters. So, when you think about the data that you saw and the breakdowns in either GDP or durable goods, did anything kind of challenge that thesis, or how would that have shifted our view, in light of this new information?
Yeah, I mean, like just judging from like the just like if just looking at the GDP and the durable goods, I mean, yeah, I mean, I'm not sure like if I mean this will definitely like raise the GDP nowcast for Q3. I mean, if like our previous view is about like 1%, I think we can at least like after this print, um, we might need to kind of like revise the growth target a little bit higher, like to 1.5 or something. But also like it's like noteworthy, like this is just like the advanced estimates. I mean, like in the future, like 2 months, like we may still like see this like Q2 number like revise. I'm not sure if it's down. Yeah, but like if incorporating with like all the regional Feds data, I see like the Philly Fed manufacturing data is up, but like for Richmond and both the Kansas, yeah, both Richmond and Kansas reported like a worse data for like manufacturing sector. Yeah, so I mean, if I have to like revise like the target, I mean, like just after this print, probably like a little bit higher, but I would assume like the incoming like the second estimate and the final estimate, I think those might be like revised down a little bit, but we'll see.
Okay, cool. Yeah, I
Just
think.
wanna. Oh, yeah. Go ahead, Mo.
Oh, go ahead, Andy.
Oh, sure. Yeah. So, I agree with Yafang on the durable goods side. I think because of Boeing, we had this very volatile aviation non-defense like aircraft segment. So I tend to discount that since it happened like since last year. So if we look at the durable goods X transportation, then it looks okay. In my motor vehicle side, it's just flat, month over month. So there's no surprise. There's no like big re-rating event on that side. It's just the aviation side. So I want to discount that factor. Yeah, GDP definitely to the upside. So I'm not sure about like increasing the nowcast though. I do feel like just from the sector I'm covering, it's a bloodbath over the last 2 days. So I'll cover more of that later when we talk about sector. But yeah, let's
Yeah,
wrap
it's
up
like
the macro.
no, yeah, I mean it's like the earnings, like I agree, like a lot of like companies are kind of like guiding downwards, I guess. For example, like companies like O'Reilly, like these are kind of like guiding down. I think those are kind of like related to like the automobile like sectors from like the parts. Yeah, like I think the earnings kind of like might just like agree with just like what Andy said. But I think like tomorrow we'll just get the initial like Q3 estimates for I think both the New York Fed and from the Atlanta Fed. So we'll see. So like for the other part of like the world, I think there's like a quite an interesting move like in the Asian currencies. I think today yen was trading at like 151 during midnight at one point, and yuan, like Chinese yuan, was like also trading at like 7.21 at one point. So there were like some like sudden like spike in like the Asian currencies. I mean, like people are associating this with the like a carry trade unwind, but I'm kind of like skeptical just to like attribute everything to this. But I think definitely like the Chinese state banks might have like waiting and just like sold some like USD. And but I didn't really find any like reports till like in the morning. Yeah, like the move has been like reversed quite a bit. I think yen is trading as 154. Dollar yen is like 154, and like offshore Chinese yuan is like 7.24. So probably like 50% of the move have been like reversed. But I mean like the overall like the during the midnight there was like some uh I think it might be just like related to positioning, like when like a state player or whatever like is like selling USD on the market, some people got like run over, and it's kind of like more of a either it's like positioning or like liquidity driven, like, but I don't think there's like anything regarding like the fundamental or like the macro. Yeah, I mean the vol still like remains elevated. So I think it's just like, yeah, I mean, although like the equity like kind of like recovered after the GDP print, like we closed almost unchanged at the end of the day. So also like vol still like elevated, like some of the long vol strategy I was like monitoring, like they remain their I mean they have like maintained their value pretty well. So yeah, I mean like just like from the equity vol point, I mean it's still like elevated. Yeah, so and just like incorporating with the uh steepening, I mean not steepening, like the flattening of the curve. Um, yeah, and now, yeah, yeah, but like the Fed watch is like having like 2.65 cuts, so it's actually like more cuts in December today. Yeah, so overall, I think it's like still like a mixed picture. In some of the part, some of the macro, some part of the macro looks like we're okay, like the consumer is still strong, but like some of the part, like the earnings, like they're starting to look weakened. So yeah, I would think like right now, I mean, we might just need a little bit more data to like get a clearer picture. I think tomorrow we have inflation, and I like on Wednesday, next Wednesday we have like the QRA announcement and the Fed and the BOJ on the same day, which is like action-packed 31st, the last day of July. So I think, yeah, a lot of things will kind of like will be like getting more visibility uh just like right at like when July ends. So yeah.
So some kind of color on the on what happened with the yen, and you might have seen some of this. If not, I'll make sure that you're on the global FX strategy distribution JP Morgan. But one of the things that they noted was there was like a over a 1 sigma demand for dollar yen downside options
I
on
see.
like for yesterday. So they said that there was that significant amount of single day options flow, and this is part of this short unwind that's happening in the yen.
I see.
And
Is that during overnight in Asia hours?
that was in
Okay.
Asia hours.
Yeah.
Yeah.
Yeah, I think it lasted like till like Euro hours. So because I was watching this like yen yuan for like the entire night. I didn't quite sleep because like
Uh,
my family like I was chatting with my family, like we're talking about like about how what how's like economy looking in China, like we just like chit chat a little bit, and they asked me like what I think about yuan. I said it's gonna like it's gonna depreciate, and then like just like 2 hours after like our conversation, it's just boom, it just went to like 72.21. I was like, oh my god. I
yeah.
was like so wrong about this.
Yeah, they're looking to hit the right hand side on the dollar yuan.
Yeah, I
um,
mean, Yeah, so that kind of like kept me awake for a little while. I mean, so I was like kept watching. So it's like about like 2 a.m. or 3 a.m. PST. Like I think they just like went to like yeah, just like during midnight. I think I just like went to like 151, but like it rebounded like pretty fast.
So,
Uh,
like, yeah, fine. Well, one of the things that I recommend that you do is, because you got to remember,
yeah.
spot is for liquidity. Price discovery happens in the derivatives market. So you've got to pay attention to what's happening in like those markets, because that's where
Yeah.
people are actually making sense, right?
All
And
right.
then ultimately you see that in the spot, but the impact of spot is going to be whether it's a noisy trading or not noisy. It depends on how liquid, like what hours, for example, the trading was happening in, and then what's like the size of the position on the other side. So those are the things that you want to track, right? You need to know, like you should always know. Like if I were to ask you, like, what does positioning look like in dollar yen right now? Like that's something that you should know. If I were to ask you,
Okay.
like, what's happening with rate differentials, right, between dollar yen, dollar yuan, yuan yen, right? You should be able to, you should have that, and then see like, okay, this is how it's changing, and not just on like the near term contract, but also like what's happening in like say over a 2 year period. So typically, I like to use like a 2 year forward as like that's like my midterm indicator of like where the rate view is, and these are like the things you want to pay attention to, and then you know ultimately you just have to remember that the exchange rate is like the tail of positioning in the rates market. So
Okay.
you just have to always keep that in mind. Little blips like what you saw last night with the dollar yen and so on and so forth. That happens when positioning is extreme and the trade is like flipping in the other direction.
Right.
So it's really important. Like if you were to know, like, oh yeah, I know that everyone is super positioned in this way, and you can see this in like futures contracts, and also by keeping tabs on what sell side is saying about positioning, right? Because they're also saying flow. So you look at the data that you have access to, which might be lagging by 2 weeks, and then you look at what sell side is saying, and you use that to have an idea about what positioning is today. And then you're tracking your rate differentials, and then we have a view of like where rates are going to be and how rates are going to shift, and so you always kind of know like what's the trade, what are the theses that are out there, and what would be a potential catalyst to switch. And that's kind of what you want to have, because then you already know like, okay, yeah, you could model in the impact of the rate differential. Like for example, if you thought that the rate differential was going to narrow, you know how we do that thing about a price target on a stock price, where you just get the ratio of the difference in enterprise values, and you can multiply that with the current price, and that tells you where the price target's going to go, like your expected return. You could pretty much do the same thing using the rate differential spread, right? So you just take a look
Right.
at the rate differential. So current rate differential versus your prior differential, and then you just multiply that by the existing exchange rate, and that'll tell you where based upon where the differential is going, where you think it's going to go, right? And so you could have plugged that number in, and you could have seen, oh yeah, well based upon my views, the yen would probably balance out around 153. Dollar yen would hit 153, and then it overextends, right? It goes down to like 152 almost, right? And then okay, that's an extreme move, right? But you would have known that it's an extreme move, because you would have known that positioning is already heavily tilted in one direction. So this is the kind of this is what we want to track, right, on the macro side.
Right.
Um,
So, just one quick question, like, since like most of the like the I suppose like for the option space for like these FX, like they're like traded like over the counter. So like in terms of like positioning, like how should I like track those? I mean,
that's what you are scrubbing sell side for. Like that's why we want. That's actually what we scrub sell side for. So like I don't really
okay, I
care
see.
about Scotiabank or Mizuho, like what their view is. I'll note it, but that view is not going to change that much over like a 1 or 2 month period. They might shift their view every 5 or 6 times a year, depending on central banks and so on and so forth, and data surprises. So that view is not going to change that much. But what's going to change is every time they send out a note, they'll give out some incremental information about positioning that they're seeing, and they may also have more like contemporaneous or like more timely data on a position basis than we do. And so we'll scrape that data from their report. So they say, yeah, we use an alternative data provider, or like for example, like when you look at short interest data, that's lagging, but you could pay for really expensive S3 Analytics or Blackline or so on and so forth, and you can get more real-time short interest data. So when Andy was at Citi, when he's on like the prime side and having to deal with that, he gets access to that. So if they send out a prime note talking about what's happening in prime, they may send out, oh yeah, this is what short interests look like. I get notes like that, which are like, these are like the top 5 short interests, that up to date. And so that's because we can't replicate that, or maybe right now like we don't want to pay for that. We just get it through sell side, right? And so that's what you want to scrape from them. You don't really, you'll look to see, hey, did they make any updates to their thesis? No update to the thesis. Okay, then what's like important in here that they've got, and that's what you want to track. Now, one of the things that I'll say is that the surprise cut in China, right, might have had something to do with this too, right? So there's a lot, there's a lot to kind of digest. But the way that you're going to want to like, what's the mechanism about how all of these will then impact the exchange rate? It's going to be through the changing rate differentials. And if you can actually figure out where that terminal rate differential will be, like where it's going to end up, then you'll know the direction of the currency. Like you'll know where it's going to go. And then if you know what the positioning is, you'll know how quickly it's going to go there.
Yeah, I mean,
Yeah,
that's
on,
kind
on
of
that
like,
positioning, on dollar yuan, I do have something to add. So these exporters in China are accumulating a big dollar position. The reason why is, they, do their, if you look at dollar yuan chart for the last couple of months, it's actually going pretty well for them. So they're reluctant to go back to yuan. So they like to keep that as dollar, and they're earning a 5% interest rate on top of that. So when you see some move like that, they'll, like, the corporation side will panic a bit, and then sell dollar and gain to Chinese yuan. So that's another positioning aspect that you probably want to take note.
Right, but
yeah,
that shift you're gonna see that in the positioning, and you're also gonna see that in the rate differential, right? So that'll tell you, like, okay, my rate differential is narrowing. People have an incentive to shift position, right? And then you look at positioning. Oh, people are already super stretched. Okay, then this is gonna happen like ASAP, right? This is gonna be a crunch. So you can kind of you'll know what the impact is gonna look like. So yeah, I think what we should do is, now that we've got the icon and like the data, we can start to build out something so you can kind of easily track what's happening, and go from there. And then when you do a scrub, I mean, I'll do this with you for a couple of times, but like walk through, like, okay, what is the like incremental data point that we're going to want to track, and when you do that, I don't want to say that it gets easy. It's not that it gets easy, but you are informed. You kind of know how you would want to posture, and you know like what to look for. So that's what I'm going to want to be as the basis for any sort of a trade idea, or a view. Is I want to hear I don't want to hear, oh, dollar yen blew up, it's trading at 160. I don't want to hear that. I want to hear that rate differentials widened. This is driving a change in positioning. This is how people are positioned. They're going to have to shift, and so this is going to push dollar yen up to 160. Like that's the layout of the logic that we're going to want to hear. But this takes practice. So we'll get back.
yeah. I mean, I did like I think I did like mention this as like the I mean when I'm like coming up that with the long yen idea, I did mention like the first factor is like the expectation of like a lower like Fed policy rate and like a higher yen, like higher BOJ like rate. But I mean, yeah, I probably need to like properly like quantify like if, for example, if like if the differential like uh like getting tightened for like a certain amount of like bips, like much will like that uh, how much will like the amount be reflected into the exchange rate? I think that's like something I need to work on to be like more precise, I guess.
Yeah, exactly. Because I think you're on the right track. Like you understand, like okay, how this is going to drive the currency, but until until you can do the like analysis, you don't know if that's already priced in or not. So that's where you're going to want to do the analysis, because then you'll know. Oh, okay, actually the currency can move further, right? Or maybe the currency is gonna is going to weaken. So all of these, you're on the right track for all of these. The additional layer that we're going to need is just to have the analytical part down, the analysis. That way you'll know. And it's not, the thing about this is that it's not a matter of, you don't want to be precise for the sake of being precise. You want to be precise because it's useful to help you understand where you're going to get it wrong. That's probably a better way to understand like why you would want to go to that level of precision. Um, and so it's going to because for example like Dr. Morrow says, it's better to be generally right than specifically wrong. But in this case, we actually want to have some specific anchor that we can reference to know, like, okay, what is something that we missed? Because if you say that, okay, well, these are the mechanisms, right? I'm looking at the rate differentials, I'm looking at the positioning, but the currency went the other way, right? It moved against me. What did I miss? And then you can triage and say, oh, okay, well, in this case, there was a specific balance of payments issue that I missed, and I'm going to have to incorporate that into my analysis next time too. Right? So it's an iterative process. The precision is going to help us understand like where we're going to get it wrong. Ultimately, like it is the direction, but we also want to know like the magnitude of the movement that is potentially left. And so that's where we're going to really want to. But did you want to talk a little about your yen long trade, or what are your thoughts there?
Yeah, I mean, I think I might need to refine that a little bit. I mean, now we have like new information. I mean, that was kind of like written before the GDP print. But overall, uh, like there were just like three factors I was like thinking like it's just like first is just the different rate path like the two central banks are taking. I mean, Fed was trying to at least like they are pretty clear that they're not gonna hike. So like everyone's like waiting for this like rate cut to like initiate. But yeah, I mean it's just like this month I think I've already like seen more like opinions about like just like start cutting like in July. I mean like the former NY Fed presidents like Bill Dudley said like waiting until September unnecessarily increases risk of a recession. I mean, these are kind of like, I mean, this type of like opinions become like louder and louder. So I think, at least like in my mind, like expected, like you Fed policy rate is lower, but like for the yen side, the expected like policy rate from BOJ is higher. So I mean, the gap between the interest rate should be like closing. I mean, that's like why I'm like having a long bias for yen. And I also think right now like the vol level has like elevated, and just like taking into account like all the political volatility and possibly like a macro volatility, like as we have seen like the deterioration of like a lot of like earning reports. I think this like vol might be just like stay here for a while. Like I think today it like almost went to like 18 on spot. So I think it's gonna like stay in this like from like 17, 16 to like 20 range until like the election results has settled. So I think this like eventually, I mean, because like a lot of funds are like doing like either like short vol, I mean like the return profile looks like a short vol like strategy, or like the positioning like it's like vol targeted, like if the vol is gonna like uh become like to like going to like a new higher level, and then like either like people are just like cutting down, it's like a degrossing event, or it's like the especially like the long carry side will like unwind their like trade. So I think that's overall is like beneficial for a safe haven currency like yen. That's like second. And I think the third is like people are just like preemptively just like hedging themselves against more China tariffs. I think that will kind of like move the like the interest in yuan to like yen, because like I mean Japan or like South Korea, I mean those are still like they can still like manufacture a lot of things. I mean if like the goods from China are becoming like too expensive, obviously like the world will like turn to like other regions for like the merchandise. So I mean like yen is obviously one of the beneficiaries from like this kind of like move, just like preemptively like hedging this. So I think that's like a third factor for like a long yen position. So that's what I'm trying to capture. I mean, of like with like a option position, we are like, I mean, it's kind of
So
like.
is there anything in today's data that would have changed that?
I think just today's data, like the stronger GDP, especially like the stronger like consumer like data, also like the private domestic investment is also like looking strong. And also like the core quarter, like I mean PCE like quarter over quarter is also like a little bit like higher than I think the consensus. Uh, s- and just like looking at the rate, also like going some like flattening. I think like the first factor, like will like the interest rate gap close like as fast as I imagine? I think that's kind of like now under we probably need to like have like better scrutiny into like this thesis, because I think today's data is still like it has like a hawkish tint. I mean, if like the Powell is still like data dependent, or doing like things meeting by meeting, I mean today's data is like I mean, has been already like being pretty hawkish against like all the advocates of like a for a July cut, and I think now he has just like some more evidence like backing him. Like he could just like like let July out and probably like September. And I mean, a lot of like I did see like some positioning about like traders like betting on like a 50 bips cut on September. I mean, today like seems like a lot of like sulfur flows are betting on this, but I think like Powell just will be like a more hawkish than the market expect him to be. So yeah, I think that's kind of like making me become like skeptical of like the I think this is like the major factor, which is like the interest differential. Uh, I would think like we should like initiate like the cut cycle a little bit like earlier or like faster, but now it seems like we do have like some room for like pushing this like a little bit like further. So yeah, I mean that's kind of like making me feeling like a bit skeptical of this idea.
Wait, I guess question is more like you're not trading just today, right? I don't think that
Yes.
trade is for today. So
No.
like does that undermine like your thesis of, more easing or like softer inflation data in, let's say, July and August?
Softer inflation data.
Or yeah, or do you think today is just like, a one-off, or like tomorrow with the June CPI data, sorry, PCE data, you'll see
Uh,
some improvement?
yeah, I think the crux of the issue is like for options trade, like you do have like an expiry. I mean,
Yeah.
if like the scenario doesn't really happen like within the timeline, and you're gonna lose money. So I mean, if like we're just like simply like long spot or like long the forward, I won't be like this worried. But since I mean it's like a options position and we really need the scenario happen
Hmm.
before the expiry. So I
Right.
think I think what makes me like becoming more skeptical of like my original trade idea is like the today's data kind of like lengthen this like timeline of cuts. I'm pretty sure like the cut cycle will still like be happening, but it's just like not happening within the timeline, if you can understand that. So
Hmm.
it's just like it's more like a time issue. So I mean, you want like the
Okay.
scenario happen before or like at a certain time point, but I mean, if we're just like long forward, then I think there's still like
Uh,
it won't be like that complicated.
I
It's just
feel
like
like
the
the question to like whether today's data change your view. I think to that question the answer is yes, right? It did
yes.
change your
I
view.
mean, kind of like shift my view a little bit. I mean,
Okay.
I'm if I'm like very bullish, like on yeah, I'm just like slightly bullish.
Right.
I mean, at least like in the near term, like for example, like 60 days. I mean, I'm not that
Right.
bullish. I mean, if like we're looking at like a longer time horizon, then I think yeah, maybe like the BOJ will like eventually hike and the Fed will like eventually cut. I mean, at some point, like
Right.
this scenario will like realize, but it is just like not at the original pace I was like
Okay.
thinking of. Yeah, I mean
Okay.
that's like my reasoning. Yeah.
Okay. But on your last point about like the China tariff side, I think it might be too long of a shot. Um,
Yeah, I
because
mean,
a lot of things need to happen in order for that to realize, right? So I think it might be
no,
easier to do
I think it's more of like a expectation. I mean, I'm sure like Trump will probably like put down something different if like he wins the election, but I think right now it's more like a expectation management. I mean,
okay.
people are like fearful of like if like Trump like getting into like becoming president and he will do these things, but whether like
Mm.
Trump will do these things, I mean, those are
It's
kind of like I mean, those are kind of like that's why I'm like choosing the expiry like in November. It's just like right after
okay.
the election. I think the crux, I mean, like the thing is like just before the election when like nobody's like pretty sure like who will be the president. I think that's why
Hmm.
when people like starting to kind of like hedging stuff. But
Hmm.
once like we know like who's gonna be president, I mean these are kind of like the flow will be different. I mean
Right.
that's why I'm kind of like choosing the expiry to just like near the election because it's all about like the pre-election expectation management basically.
Hmm.
I'm not saying like if Trump will win or like he will like immediately like put out like he will just like immediately like execute like China tariff policies, but like right now it's just like I think it's more about like expectation management. Yes.
Right. Right. But and the long shot part, which I was thinking is like if you get this tariff on China, then
Right.
it's gonna, the manufacturing of, batteries or like chips or whatever will move to like Taiwan or Japan
Yeah.
or Korea. I think that is debatable whether that will happen quickly for that trade to realize.
Yeah,
Um,
because so that's why the expiry is at like November. It's like probably like 4 or 5 days right after the election results. I
But he's
think
not gonna do it on day one, right?
no, it's not gonna be like day one. I think it's just like before like the management and also like how like
Uh,
BOJ and Fed kind of like interact. I mean, yeah, I mean it's just like before election, I think there will be like a long yen bias, but I'm actually like I don't know like what will happen
yeah,
once the election has like concluded and like we know who's president. So I mean,
right.
that's why I'm not kind of like trying to like put this trade like later, for example, like in December or like in January next year. So I just wanted like to I mean, I can even like get out before the election as long as like the
Mhm.
yen just moves up like higher and high enough. I mean, it's just, yeah, I think that's basically like the thesis. I'm not kind of like adding on like the like the realization of like a Trump presidency or like his
Yeah.
tariff policies, but it's more of like beforehand, like how people are gonna like try to hedge this. Because right now, if you look at like many polls, like I mean, it's like pretty close, right? It's like the Harris and like the Trump.
Mhm.
I mean, like they're polling like pretty close. So like either one is kind of like very probable like to be like the president. So I think just people are just gonna like or like firms gonna like at least like right now they're gonna prepare for
I,
like a
I I
possible.
I think for this trade to work, it's easier to stick with rate differential story. Is
Okay, all right.
is
Yeah,
my hunch.
Okay,
yeah, that
let me just jump in here.
Okay.
It's always going to be a rate differential story. You have to
yeah.
translate a political scenario into a rate differential story. So, for example, what happens to the U.S. yield curve if Trump becomes president? It's going to steepen, right?
Mhm.
Because he's going to have a massive fiscal policy, and
Yeah.
so you're going to get the long end probably sold off by say probably about 100 basis points.
Mhm.
The short end probably won't move. We might end up in like a higher for longer, even in the front end scenario in that case, right? So that would be the Trump trade, a steeper yield curve. Well, how would that impact Japan? Would Japan experience a steeper yield curve? Will the Trump presidency actually impact Japan in that sense too? Probably not. Yield curve is probably not going to be impacted from a real rate and expected, inflation, standpoint. So you're not going to get a shift you know in the yen curve, but you will get a shift in the dollar curve. Dollar
Okay.
rises versus the yen, so the yen will weaken versus the dollar in that scenario. Okay, so in a Trump trade, the yen for sure weakens versus the dollar.
Mm.
In a trade where Trump is not going to win, then what happens to the yield curve? Then I would say that we could trade the status quo, and the status quo is that the yield curve is going to continue to invert, it's going to continue to flatten until the Fed starts to cut interest rates, and then you're going to get a massive steepening on the front end.
Right.
Okay, so if that's like the trade to make, what do you expect is going to happen to the dollar yield curve? It's going to move lower and lower and lower, and even if it steepens, it's going to steepen on the front end, right?
Yeah.
So
Right.
what's going to happen to the rate differentials? Well, Japan is like slightly outperforming the United States right now from like a say like an expectation of growth, trajectory. Although that's has kind of faded a bit, so we'll see if that persists or not. And in that environment, you could get slight like you could get a little bit more narrowing of rate differentials. So in the status quo trade, you end up with the yen slightly strengthening versus the dollar, not like majorly, but a slight strengthening for right now. And then we'll see what happens if the Fed actually begins to cut rates or not, right? So post
Mm.
post August into September, we'll actually know, what the Fed's kind of stance. I mean, we'll know a little bit in July, but it's really going to be after the CQ update in the end of August, and also Jackson Hole, and then the SEP, FOMC. That's going to tell us what the path of Fed policy, the rate cutting cycle is going to look like, and then you'll see that the bond market is going to shift dramatically based upon that new information. That's like the major catalyst there. So that's how
Yeah.
it tie up the trade and understand like what's the dynamic that's going to take place. So, Trump trade is going to lead to that steepening. That's a weaker yen. Status quo is going to lead to slightly strengthening yen, right? Not major. Now, one of the things that I want to highlight is that always need to translate. You always have to translate views or politics into a view on the yield curve. Okay, that's like, you just have to do that. Okay, and because at the end of the day, it's the shifts in the views in the yield curve based upon this information that ultimately leads to the change in the currency. So, for example, this chart that I've got up over here, this is dollar yen in versus U.S. rate expectations. Okay, this is WIRP, so interest rate probabilities. Okay, for December, and this is a chart crime because I'm using two different y-axes. If I use the same y-axis, trust me, you're not going to see. You'll see like a small little blip. It doesn't really show anything. But why I think this is super important is because if you see the dislocation that happened, it happened in these two securities. Okay, so there's something that happened to both things at the same time. Is what I'm getting at. So that's how you know that it was a rate driven, or a change in rate expectations drove shift in the yen. Okay, it's not that this is the dollar yield curve. If this was the dollar yield curve, then it would have been a change in the Japanese policy, would have led to a shift in the spot. But in this case, this is interest rate probabilities. This is like Fed funds futures, right? So someone was in Fed funds futures and had a cover in yen is the point. So some thesis got derailed and had to be sucked out. So this is why, this is just how currencies trade. Like, you just have to, like, nothing trades on the narrative. Okay, nothing trades on narrative. We have to, or hedge fund analysts have to take the narrative and apply it into a model to get to what the actual impact is going to look like on the underlying asset that people are trading, which is generally going to be, for macro, it's going to be yield curves. So we have to go through that process. We think that, oh, this news is good. Oh, war risk premium. Oh, there's going to be war in China or war in Russia. Okay, how does that impact the yield curve? Everything has to impact the yield curve. Okay, so we have to go with yield curve first, and then we can say, okay, well, now that we know what we think is going to, how this would impact the yield curve, how is that then going to shift probabilities of like cuts or hikes? How's this going to shift positioning? How's this going to shift then also cross currency, items? And so again, emphasis needs to be on the yield curves. Now, status quo thing is, you look at PMIs, and both the United States and Japan are showing a bit of a cooling, PMI story. I think Japan is a little better, like slightly better, but or maybe the U.S. is now. But yeah, it's definitely something that you're going to want to pay attention to, because as these data points come in, we're going to have a better idea as to which countries are actually performing, and then what is the impact from a policy standpoint, right? If Japan has started to like rebound since the beginning of the year, is this simply another Q1 fade like we saw in the United States, or is this something more, right? So that's going to be a question that you're going to want to unpack and understand in order to to kind of develop the view. So we always want to tie stuff to yield curve, and I'm gonna don't worry, I'm gonna always hammer this in. This stuff that I have to remind myself constantly too, because it just happens. So I would actually say your view of a long yen, trade, right, would be contingent on the shifting view that perhaps the probability of Trump winning is less than or equal to 50-50. So the right, because if you think about Trump, that would be a curve steepener. If you thought a status quo, that would be a curve flattener. And so in that dynamic, a steepener means a weaker yen, flattener means a stronger yen. So how would you trade that? You would say, well, okay, if it looks like maybe Kamala Harris might have a chance, then maybe that's the rate differential that you would expect. You'd expect that the yen to actually strengthen. And maybe you could point to like recent weakness to be like, hey, now's a great time to put on this trade because everyone is on the Trump trade right now. And actually, if this is pricing in, 80% of that Trump trade, it should only be pricing in 50%. And so this is a good time to jump in. Yeah, that's kind of how you'd want to do the setup. But this is how you're going to want to triangulate it and get to the specific of where the rate, how your view of some political thing is going to impact the yield curve. Now, one of the things that is also important is that the yield curve, politics is not the only thing that impacts the yield curve. We have a lot of things coming up that are going to impact the yield curve. For example, we have the July FOMC meeting. On the 31st, on the day that we have the July FOMC meeting, we also have QRA, the quarterly refunding announcement. So those are two things that are going to have a massive impact on the yield curve. And by the way, this time it's going to be even crazier because we're going to get so I've been talking to you guys about how there's been an implicit strategy to dampen vol. And what is the mechanism for the dampening of vol? It was the Treasury via their QRA. So when they announced their this quarter's refunding and their year's outlook, they shifted their duration match to reduce their duration exposure. So when they based from where people thought it was going to be. So given that shift in duration exposure, a lesser impact on duration, that means less of an impact on liquidity, and therefore it meant that actually the liquidity difference was positive, and so that acts as the easing to, say, U.S. or Treasury-based assets. And
I think that's what Stephen Moran write in his piece. That's basically it.
Right. So Moran and Rubini, they both agree. But one thing that I want to say is this is actually kind of consensus on the street, I would say, or amongst macro, on the hedge fund side.
All right. Yeah.
I don't know how much this is talked about in FinTwit, but in if you cover macro, then you're aware of these things and how they impact stuff. So you would have known that last quarter was a surprise, and you would have known that surprise would have led to a softer FCI or financial conditions, and that would have then boosted Treasury-based assets. Because of that, there's a marginal reduction in the amount of liquidity that needs to absorb duration. And that's the setup, right? So now kind of coming into this quarter, the question is, well, could we get a surprise? No, everyone is saying probably no change in expectation, but everyone was wrong last quarter too. And generally speaking, the Treasury on the margin can drive a surprise. So I think that Yellen is cognizant of the fact that the economy is it's not as I don't think she's gonna be fooled by the 2.8% GDP print today, right? So she's she's aware of what's happening. And in fact, I got to give her credit because she was the market's favorite FOMC member back in the day, because she was the only one who saw. She was one of the few at the Fed who saw 2007 when it was happening. She would run these private surveys of dental practices, I think orthodontists, and she found that there's a correlation between people getting their braces done and the strength of the economy. And it was funny because there was a conversation she had with another Fed member, and he was saying that he had a very bullish outlook on the economy because he was surveying business professionals. But she had a very bearish perspective on the economy because she's doing this survey of. She thought that was more correlated with consumption. So very interesting. So I think that it's good to kind of expect that she understands this. And what does that imply on a QRA side? It means that maybe we get a little bit more easing, right?
Okay.
From
so
a
more
QRA
bills.
standpoint.
Yeah. So more bills, less coupons, basically.
So if we get more easing, what do you think is going to happen to the U.S. yield curve?
So
what would the impact be to real rates? Or rather, this is actually going to be a term premium issue. What do you think happens to term premium? Term premium is the difference between the 2-year and the 10-year, say.
2-year, 10-year. So I think it's still gonna be so steepening, right? Because we kind of lower the front end, and the long end is gonna be less coupon. Let me see. So let's.
you had it right, but it's not. You're getting confused just because the 10-year is already below the 2-year. So if you think that the 10-year is going to be relatively like not impacted, but you think that the 2-year is going to be impacted, that would end up being flattening. Well, we're in an inversion. So because it's an inversion, if we go more deeply inverted, we just many people just call it flat, more flattening, versus steepening. So that spread is getting like smaller. It's becoming a bigger negative number, put it that way. So that would be an easier financial conditions. Okay, so that's the risk for QRA on July 31st. Now, what's going to happen with the Fed? What's the risk of the Fed, right? I think everyone knows that the Fed is probably going to be, or at least we have been talking about this for the past couple of weeks, that the Fed is going to be a little bit more hawkish than they need to be. And today's data supports that, right? Today's data was a surprise because it was so hot that the Fed is probably going to say, okay, well, maybe we can be patient because the data came in so strong. Okay, so you get that dynamic where you're going to have the Fed being slightly more hawkish and the Treasury actually countering that by being slightly more dovish, and you get like a mixed effect. It's neither positive nor negative. The net impact. I mean, that would be something to kind of we can try to model what the estimated impact would be, but that tells us what the position is going to be, right? So in that environment, you would think that okay, well, the easing should boost or should keep the 10-year where it's at, even in the case of Fed hawkishness. So you might get a little bit of the front end move up because of the Fed, but you also might see that move up be impacted by, or like that would be potentially exacerbated by the Fed refunding, right? If the Fed increases their short end refunding, then what happens to the 2-year? Like imagine there's two negative impacts to the 2-year. One is the Fed that's going to say, hey, we're not going to cut so quickly. And then two, the Treasury is saying, we're going to issue way more, bills and up to 2-year sort of notes.
Right.
So where could that push the 2-year? The 2-year is trading at 4.43 right now.
Yes.
Would that push the 2-year higher or lower?
Higher.
Yeah, exactly, right. The 2-year would get pushed up, maybe to like 4.6, 4.7. I mean, that was like my rough estimate, a couple of weeks ago. And so you'd get that move up on the 2-year. What would happen to the 10-year? Well, the 10-year would probably stay roughly flat, say around 4.25. So what happens to that negative spread? That's gonna
there's like more flattening. Yes.
Right. So if the dollar curve flattens, okay, and this is a near-term catalyst, okay, dollar curve flattens a little. What then do you think is going to be the impact to the yen? What happens to rate differentials?
See, like the 2-year went higher.
Yeah, versus the Japanese 2-year, right?
Yeah.
So what currency is strengthening?
So it's like gonna be dollar.
The dollar strengthening, which means that the yen goes higher or lower?
Lower, but I mean that day also has BOJ announcements, so.
Right. So, okay, so that's exactly like that's the setup, right? So now we kind of know, what's the dynamic involved. If the BOJ, what's expected? Probably nothing, right?
Yeah.
So, but the yen might still move a lot because of what the Fed does.
Right.
In fact, if we know that the Fed is going to be a little bit more hawkish, like we can, I think that I have got like maybe a 70% confidence that that's going to happen. Then what do I think is going to happen to the yen? It's going to weaken between now and, or it's going to weaken like right after. So maybe for August 1st, I'd buy like a put on the yen.
Yeah, makes sense. Yeah, so it really depends on like, I think like that Wednesday or like the Tuesday evening is gonna be like very exciting.
Right.
Yeah. the all day is just gonna be fireworks.
Right. And that's why we want to have an idea of this like beforehand, right? We want to like go through and like have the scenarios laid out, mapped out. So that way once once we know what's happening, we can then go ahead and make the trade. Right. So for example, if we think that this is going to lead to a weakening, like the yen has strengthened over the past couple of days.
Yes.
So this could be a good trade because it's early, right? We got a little bit of that weakening that happened today, right? Or say last night or yesterday in Japan. But I mean, what do we think is going to happen today? Probably, it's going to move. It's going to have to move back up because that's the dynamic that we think is going to happen, regardless of what's going to of what the outcome is. Like it doesn't really matter because BOJ is probably going to do nothing. We're going to get a QRA that's probably going to be slightly more dovish, and we're going to get a Fed that's going to be slightly more hawkish. That's going to push the 2-year up. If it pushes the 2-year up, then we're going to get a weaker yen. We can go and do the math. Probably have some time to do that tomorrow if you want to go through it.
Yeah, sure.
Cool. Okay, guys. Any other questions on macro?
Just got some color from the Asia trading desk. There's tons of people long dollar yen, even the banks. And long Aussie, long, dollar Japan, they, all get killed yesterday. There was no flow whatsoever, nowhere to be found. Tons of stop loss order, or like limit stop orders being triggered. And no bid can be found on the screen. That was during Asia hours. It was crazy. And London, they said when London came in, it kind of stabilized a bit, but then got another leg down. And the New York people are not happy waking up.
Yeah, I can imagine.
Yeah, I can imagine. I mean, the yuan move also caught me by surprise because China's cutting rates everywhere, along their interest rate corridor, and I was thinking, it's gonna be weakening, and then it's just boom, someone just waiting and just sell off USD. So
and just they say people are repositioning for the BOJ next week. So
okay.
So there's a little bit of reshuffling going on.
A yen move. So when the PBOC when they do that, that should lead to a stronger yen when they cut. Yuan cut on a relative basis, stronger yen.
Right.
All right.
Yes.
And there was some crazy movement in the onshore and offshore yuan. Just tons of R being picked up yesterday as well.
Nice.
So that's the Hong Kong side and also the Hong Kong versus mainland. All right. Let's pivot to coverage, shall we?
Yes. Go ahead.
So pretty horrendous couple of days. For the automotive side. So first of all, Tesla released earning, and covered it in our chat. I think James, they are pretty happy probably about it as well.
Hey, James. Go ahead. Sorry.
Oh, okay. Quick read. Auto business, we got some clarity, and here on my thesis that the production ramp is going well, but we'll have some headwinds in Europe due to the tariffs. So they are thinking about how to reorganize the product or the geographical mix to see whether they ship less vehicle from China or produce more in Berlin. And it is an ongoing process they're trying to solve. So that hit one of the thesis. The other is on the energy side. They did say it's pretty lumpy, but on the other hand, they said they're gonna produce in China as well, so they'll have triple the capacity in Shanghai. I don't know why they do it that way, or maybe they will have tariffs on that. But if Elon Musk got some kind of in news from Trump or whatever, maybe that's okay. So they decided to do it in Shanghai for the expansion on the energy storage side. So that business side is going well, but we'll see whether Q3 is going to be a stellar result because it is lumpy. So not going to extrapolate too much. On the robo taxi and the AI side, even the semi and roaster, we got tons of visibility. So they are going to release the the robotaxi event on October 10th. Elon saying he's fixing some issues, bringing more updates to the robotaxi, and I think it's it's good. It doesn't change the narrative too much, um, but he said he's probably gonna he is going to produce these cars in Texas. So that's one thing that's being confirmed. Secondly, on the semi, he said he's also going to start producing next year, and that will be in Nevada. And roaster, he also says next year. So it's pretty interesting how like he pushes everything to next year, and then like if that's the case, and also the Optimus robot. So if that's the case, then they will be launching 4 products next year. And whether they pull it off or not is a question. But I will be tweaking my models to incorporate these scenarios into them and see what the impact to the headline and EBITDA will be if that's the case. And then we can use the percentage certainty thing to change around the price target. So that's upcoming. So yeah, stock sold off, hit my price target, and I trimmed my short position, and I think I closed out most of it when it dipped below 220 yesterday. It's overshot my price target, so that's a pretty good result. And I added on some Rivian positions from like small long to like medium long. The reason why is this sell-off in the auto sector, especially in the EV, was related to Tesla and Tesla only. The gross margin side is fine. They just spend too much money on AI and then it's hurting the bottom line. So I don't think that will have the same impact on Rivian. Due to the ASP issue isn't as severe as I thought and as the street thought. The gross margin side is still intact. So so that's the positioning change. Let me see. Yeah, and then we move on to the traditional legacy OEMs. And geez, what it's pretty crazy. Ford has the biggest one they dropped since 2008. So let's start with Ford. Ford is, I think, the worst performer so far. I'm not just saying on the price. I listened to the call yesterday. I look at what they did. Like all 3 of their major sectors have their own issue, right? So the Ford Blue, they have tons of quality issue. They spend tons of money on the warranty, and that's been just dragging down their earnings. So that they do have a top line beat, but the EPS side looks super ugly because of that. Ford E again, it's losing money. They don't have any scale, and I'm not hearing any solid plans. Ford Pro, it's really maybe one of the bright side of the earning. They're selling tons of trucks and SUV, which is a common theme across the industry. However, they are limited by capacity, so that's why they are opening up that new capacity in Canada, not in US, by the way, in Canada to produce more trucks. So they didn't see that coming. So like you should, if that's the case, then you should have increased capacity a lot earlier than now. So all 3 sectors are down. Segments are not meeting expectation, and I think they during the call they try to save it. It's not like, oh, we recognize the issue and then we're solving it. They just kind of just kick the can down the road. So on the other side of the spectrum, Stellantis today also reported stock down 7% today. But even though it's bad, their management is very quick to acknowledge that yes, we see the problem. So what are the problems? So they spend too much on R&D, capex, and M&A. they have some operating flow, headwinds, and the U.S. market, marketing techniques didn't work so well. And what's funny is they said like the reason why U.S. is down because we can discontinue tons of cars that people love, like the Challenger and Charger. So all of these cars are being taken out, and they don't have that new cars to fill the void, and that's really what's dragging down the earnings. European side, China side, Asia side, it's fine. But I really like their way of approaching it. Is that yes, we understand the headwinds, we are aware of it. We are taking active steps to solve the problem. So I'm like, okay, cool. In their earnings slide, they even have that flowchart of like what they need to do to get back on track, and it's unlikely to recover until early 2025. So the second half of the year will be affected too. But I really appreciate the visibility, and therefore, the first step for solving a problem is that maybe you have a problem. GM side, it's I would say the earnings side is the best of the three. EV still lags, but trucks and SUV still holding up. But they did decide to push back on the EV side and cancel the Cruise Origin vehicle. They say it's a regulation issue because you don't have a steering wheel or pedals. But Elon Musk on the call just roasted them, saying they couldn't do it because they canceled it because they couldn't pull it off. So I was like, okay, so some shot fired. And similar issue in Japan and Europe. Nissan, Porsche, and Renault all like saying the same thing. This slowdown in EV adoption, and headwind in China. It's really the same theme going on. So that's why it's kicking the whole sector into reverse gear, and that's what we saw. And on the positioning wise, I mean, rightly so, because everyone was latching onto this hybrid story in the beginning of the year, and people were long these legacy OEMs like Stellantis, GM, and Ford, and shorting Tesla, Rivian, and Lucid. And people didn't see this happening on the car is because the delivery number on the surface looks okay in Q2. And that really blew people out of the water, and then I guess there's tons of unwinding their long position, and it's just again people get shocked by the result, and everyone needs to get out, and then when everyone rushing for the exit, that's what happens. So yeah, on the China side, there are basically a couple of ways people look at, like manufacturers look at these issues. One is like, yeah, like China now just becomes a very small very small percentage of our total sales globally, so we don't care. And the other one is, we still want to have an exposure, and then they believe the China market is gonna recover. So these are the two like main ways people are dealing with it, and Porsche is like the third way, is saying we don't care about volume anymore. We just want to keep our brand image in case the economy recovers. So we're not going to do any incentives, and we're just going to leave it be. And yeah, like that's the major take. And on the production problem, Stellantis did say they're going to cut back production. Tesla said they're going to increase production in Q3. And other two manufacturers like Ford and GM, it's like even, because they are in this dilemma. It's like they don't want to say we're gonna cut back production because that means you don't have scale. Then your EV segment is gonna keep losing money. But they don't also want to say we're gonna increase production because now your inventory is already blow up. It's like you have 60 days or like 90 days of inventory. And I was like, yeah, like if you keep saying that we're gonna increase production, then that's not gonna help the inventory issue. The car's not selling. So therefore, net they are in this really awkward position. It's like it's kind of wrong to go either way. Either I save the inventory, or I don't get my fixed cost spread out on scale. So that's the real dilemma. The one bright side is like Hyundai is actually looking pretty good because I mean their hybrids are selling really well, and their EV, the Ioniq series, they are arguably really good cars coming from a traditional OEM. And to me, like I wrote in the note, the fundamental issue here is you gotta build a car that the consumer want to buy. If you don't build a good car, like an EV, then obviously it will hit these dilemmas. Um, so, and then we see that Hyundai actually, turns out to be, not following the common trend. So yeah, so that's my quick recap of what's going on in the auto sector. So let me see. Coming up, we'll have more. Let me see. Yeah, so coming up, we'll have early August, we'll have Rivian Lucid, and then after that, we'll have tons of like Chinese ADRs reporting afterwards. So we can gauge how the Chinese competition is going, especially their export strategies. And we have some Japanese companies also in the beginning of August and end of next couple of days and next week. Yeah, so that's about it. So on the Lucid side, I want to comment on Aston Martin actually didn't say anything about their collaboration with Lucid, which is pretty interesting to me because I know they pushed back on the the EV development, but still, if they didn't mention anything, that's pretty weird. And on, I think it's Ford's side, yeah, Ford actually said explicitly in the earnings call that they are interested in, or like they're open to collaborations in the EV sector. Maybe they just couldn't put it off, and they need to figure out any partnerships because, like I said many times before, the more allegiance that people have, the less options you'll have. Right? Rivian already tied up with Volkswagen, and Stellantis is with Leap Motor, so that's the Chinese company. And there's only so few pure play EVs out there, EV makers out there that's performing well. So I don't want to say that there's going to be a bidding war, but I think it's going to be in the pipeline because they do say on the call that we don't want to announce anything on the earnings call, but when it happens, we'll let you know. So that make me more optimistic about joint venture and collaboration and partnerships in the future when these traditional OEM are spending tons of money. They gotta cut back on the cost. They don't have scale, but if they can have a joint venture and spread out the cost with someone else to save their EV segment, then it'll only take them a couple of quarters to realize that this doesn't work. So yeah, we'll see. That's a quick recap. I'm sure there's more to come, but today is like a really heavy day when all of these earnings happen. So yeah.
Super useful. Thanks for that, Andy. James, I wanted to get you looped in. How are things going on your end?
I was generously muted out. I've been horrifically sick, guys, and I've had like what we thought was RSV or COVID or something, but it was none of the above. It was a lung infection, and they gave me some drugs, and the drugs turned me into a diabetic for a few days. So it's been like awful, and so I don't really have much on. I had the coherence to take off most of my book. Yeah, because I wasn't sure how long I was going to be like this. But the numbers, the personal numbers are trending in the right direction. So I'm just trying to catch up on earnings and everything that's happened and figure out how I'm going to position over the coming days. And my primary takeaway right now is I'm starting to like the pricing of the hyperscalers relative to what I think their earnings expectations are. And I think this pullback has been good. These companies, especially the cloud companies, are going to do very well. And so I'm inclined to get long them slightly into the print. Subject to volatility positioning and whatever else happens, whatever once in a lifetime scenario comes to fruition in the next couple of days, going into next week. But my plan is to be long vol and slightly long delta into the weekend, and then trade that into a number of single name longs primarily, and I have a few shorts. And the only one that I had that I missed while I was sick was short Chipotle, and I think most of that was already priced in anyway, so it didn't do very much, and so I didn't really miss very much in that trade. That's what's going on over here.
Certainly
really
hope
cool.
you feel better.
Yeah. I had a my parents actually, they were on a flight recently and they got really sick too. And then I guess when they got back, they got my siblings sick too. So good thing that you're kind of lodged away, but hopefully it's not too bad. You feel better soon.
Yeah, my wife has got it. She's miserable also. Whatever it is, if it's a new, yet another virus unleashed on humanity, it's a long lasting thing. And like I said, they put me on steroids, and that totally shot up my blood sugar into diabetic ranges. So it was not good.
Right.
Wow, yeah. I do agree that some of these vol events that make some stocks more in a more attractive multiple side, because it's just nothing fundamental has changed for these companies. It's just flowing with the market.
Yeah, I mean, looking across my coverage has expanded to 32 names now, and I've been putting a lot of effort into just getting really good at the systematic process and building all the infrastructure I need to be able to track.
Mm-hmm.
And so I've gotten in a pretty good position with that, where at least I can build models, set targets, and track relative pricing.
Mm-hmm.
And so names like Google, Microsoft, Amazon, Vertiv, Moneyline, even Coinbase, Robinhood, are looking pretty good for me right now. Some other names: Visteria, Tidewater. Palantir's reporting. I think that one's overpriced, so I'm considering a short there. But they're, that's a little bit dubious because they're expanding so rapidly in their price, and I think that's probably going well. So I probably won't take that one, but I don't see a trade in it otherwise.
Okay. I guess the burning question from my end is, it's not in my coverage, but how's Google and CrowdStrike? I think we need to do a recap on that. It's postponed for almost a week.
Yeah, I think you're seeing a lot of estimates come in pretty quick, right, on CrowdStrike. So I've been trying to tease out of the model where to price this thing, now that's coming out. And I've also been calling a lot of friends in the industry just to say, hey, what are you guys doing with CrowdStrike? What are you doing, with your existing contracts? And so the consensus I have is that, and this is a few days old now because I got sick, but none of the existing, it's extremely hard to rip out this product, extremely hard to turn it off even. So people are just sort of grinning and bearing it for the time being, but it's going to come up for discussion in their next purchase cycle, how they want to, do they want to plan to stay on it and then plan to get off? I mean, it's a great product, and it's until now was a widely loved product, and truly best of breed. So I don't see it getting ripped. However, I think their sales pipeline is trash. I mean, it's the PR, it's a PR disaster, right? So I think their forecast is way off. I mean, they're going to lose 30 to 40% of their pipeline. There's just, I mean, minimally, right, and maybe more. And so I really think that's going to put the next quarter in jeopardy, and they're going to have to either aggressively, cut sweetheart deals for the year as kind of a mea culpa, discounting, maybe bundling. I'm not sure, but it's at risk for sure. And so when I tease it out, like I think I'm just looking at my model on the other sheet here. I think the range is like 216 to 341. It's trading 254. So, for me, I think if it dropped down into the low twos, I'm going to consider that a buying opportunity. As it sits right now, it's not quite enough margin of safety for me to want to get involved with it. Beneficiaries, right? Like, I think Zscaler benefits to a degree. I think Palo Alto benefits to a degree. But again, it's the best product. It was the best product in the industry. That hasn't changed, right? So I think we'll see what their PR campaign is, but like, how are they going to prevent this from ever happening again? Is going to be a key reassurance that we'll need to see for them to sort of fix their quarter, or have a chance of fixing the quarter. What else happened?
Oh yeah, Google. Yeah, Google.
Yeah, Google continued, like the last 4 earnings calls, and in particular the analyst conferences outside the earnings calls. They've been getting peppered more and more regularly about their AI and infrastructure investments, and like, when is the ROI going to come, and what is adoption? And of course, I think they're really mismanaging expectations. The really big news, of course, is that OpenAI just declared today that it is entering the search market. So it has released a search-based tool to 10,000 users, and based on previous OpenAI releases, we can expect it to go from 10,000 to 100,000 to 1 million to 10 million to 100 million in the course of a few months, right? So I think into the next quarter, Google's going to be, in their core search business, up against an extremely formidable and disruptive technology that could, depending on how good it is, depending on how well the anchoring works in search results, it could begin to disintermediate them immediately. There's other tools out there like Perplexity, for example, which are okay, but just the technical prowess of the Perplexity team versus of the OpenAI team, and what they're likely to have done. I haven't seen the search product yet. I'm not one of the lucky 10,000. I don't think I'm going to be in the first 100,000 even. But yeah, I think that's very bearish for everything Google's trying to productize. However, Google has the best data in the world in terms of not just having the data, but their ability to work with it and retrieve it and store it, in the first place, and to collect it, right? So I think technically, Google should have vastly superior, right, AI augmented search. The problem is cultural. Like, they have their heads up their collective asses, so they're focused on the wrong things, and they've never faced an existential threat like this one. Like, even when Microsoft turned its guns into search, it was a pathetic product, right? To the degree that Microsoft, at one point, I don't know if they still are, was just copying Google search results. So my main concern is that I think the company has the wrong leadership at this point. I just don't see I don't see them navigating with this sort of like culturally, like, cautious. We're going to do it our usual Google way. We're going to introduce it to market and then iterate, and Sam Altman's coming for blood. and he's backed by
Mhm.
their biggest competitor. So that turns me pretty bearish because I mean, not technically, it's just it's all on the team and execution and the fact that they can't seem to get organized around this mission to curb the existential threat that they're facing. They're still wrapped around their own inertia barriers as a company. And I've seen this before, with big tech companies that were top of their industry and then completely flubbed it. I mean, IBM, for example, um, IBM should have IBM was the ideal company to become the cloud. Actually, they just didn't. So anyway, I think that's where it's at. And now, I think that's a real risk to Google earnings if Altman gets this thing in market and it actually works, and let's just say it's as good as GPT in terms of leap of capability, like to the end user. That's actually going to. I mean, I don't know about you guys. I'm already in the situation where I ask an LLM usually before I go to Google search now already, like right now. I tend to ask things to Perplexity or GPT or Claude before I ever hit Google, and just to save time. And if I find something I need to validate, I go validate it.
Yeah.
So this is a real search product. God's help them.
Yeah. I mean, I still use YouTube quite a lot, but yeah, on the text-based searches, yeah, obviously, go to ChatGPT first. And most of the time, my answer, like 95% of the time, my problem just solved. Unless it's some like really like niche thing, then I hit Google. Yeah. Mo, anything to add here?
So, couple of points. I think on CrowdStrike, I think it's super attractive right now. I would add and probably go a little aggressive. Like this would be like a max long position into earnings. Now, the thing about this is, what's happening is, yeah, your full year and next year estimates might marginally be moved lower, but I don't think we're going to get like a big billings, disaster. I think actually what's going to happen is we're going to get CrowdStrike and Microsoft working more closely together, and that's going to offset a lot of these like worries. It's not like that it's not that we had a breach, right? It's that this was like a stupid update issue, right? So, you know, this is not something where it's like really the product's fault. It's obviously something about how they updated how they upgraded or updated their software, and has to do with a completely different sort of stack. So I don't think it's going to really impact, the company's buildings that much. I also don't think that it's going to benefit, Sentinel One or Palo Alto or these other guys because, no one really has like the depth of platform that CrowdStrike has. I mean, Sentinel One is so distracted by, their own issues, like trying to be free cash flow positive and improve those margins instead of growth, that these firms aren't even like positioned to really benefit. Palo Alto might, like they would be the only company that's probably, in the cybersecurity space that probably would benefit from this because they actually have the go-to market strategy and they have a really deep sales team. The problem is product market fit. They're not at all what CrowdStrike is from like a cloud native, security, software standpoint. So I think that this actually strengthens crowd. This was a little bit of like a humble brag in how many people were impacted by the CrowdStrike's outage. But I think that this ends up being, I think this ends up being a nothing burger. And I think that the right analogy here is actually like a decade ago, there was a Bloomberg outage for like a couple of hours. And, everyone was talking about how like, oh, this is going to be the end of Bloomberg, right? And nothing happened. It was sure, like the asset management industry has declined, but I mean, did not impact Bloomberg's market share, at all. So I see the same thing with CrowdStrike. Like, imagine if you're like working through a deal right now, and like, the IT, budget guy on the other end of the line, like, what's he gonna say? like, oh, I've decided that because you guys had an upgrade issue that like I'm not gonna get on CrowdStrike. No, like if anything, maybe they could get a little bit more concessions. You could get like a little bit more, of a benefit. And I think that's probably what IT staff are pushing, or like customers are going to push for. But I don't think it's going to result in some massive, or like even a very substantial impact to their buildings. Now, the risk is that even if you don't get that substantial impact to buildings because of their better product market fit, what is like, what is the opening? What is the weakness that comes out of this? I think actually the beneficiary of these ends up being the hyperscalers. So I think that like Amazon and Microsoft, they're gonna release their own tools that could probably manage some of this, some of what happened. And I think Microsoft in particular, right, will benefit because they just released a security software Copilot, and their security business is worth $20 billion a year. So I think that's something that's like a very important distinction to kind of keep in mind. But I think that instead of Microsoft kind of going, all in to win share, because I don't think Microsoft is kind of like also, they're kind of like they're also in the penalty box right now because of what happened. It's really like, I don't want to say it's like their fault, but like, the crash update on Linux and Mac, like that didn't crash, right? It was the one on Windows that crashed. So because of that, I think that Microsoft is going to be a little bit more defensive in their posture. To me, this suggests further collaboration between CrowdStrike and Microsoft. Like that's what I think is going to be the outcome of this.
Yeah, I'll add an anecdote that I did. One of the security professionals I talked to did bring up Microsoft Defender as like, or Endpoint Defender as like the go-to in terms of a swap. One nuance in what you're saying, though, that I wanted to bring up is that, it's not, it used to be like, I don't know if you remember, like back in the .com days, people were like, oh, if Amazon goes down, they'll lose millions in e-commerce and the customer will never come back and they'll go buy something else for somewhere else. And that proved not to be true, right? So we've seen repeatedly, like in Bloomberg style outages or Amazon style outages where the site's down or whatever, you can't do it. If people just go do something else for a while and they come back and they, to go back and do whatever they were going to do in the first place when it's back up again. The difference with this outage here is that this required manual remediation on the part of the IT teams, and it wasn't a simple reboot. It was like 16 reboots, So when that happens, the IT people become particularly vindictive, because they're IT, speaking as an IT professional, it's a completely thankless job. No one ever thinks about you until something is broken, right? And then you're the worst person in the world, right? So I just think that, from what I was hearing even from on Teams, like these remediations are still going on, right now they're still going on, right? And even though like most of the core systems, by now have been restored, there's a lot of stuff out there that is still bricked and it's going to take weeks and maybe months, to clean up. And that is different than, like when Bloomberg goes down for a while or Amazon goes different for a while, because you've eroded trust in the IT team. The IT, the buyer is now thinking, there is one other little dynamic, like the CEO, is always, when it comes time to sign that check or whatever, right? Like I've been in this position, right? So we're going to pay for the thing that just took the company down, right? So I maintain that it's going to kill their pipeline for a while until they have a really good answer about how it's never ever going to happen again. And in the end, like I think you're right. Like it's not like the pipeline disappears forever. It's just delayed versus where they thought it was going to be. That's what I think. That's my nickel.
That's a good point. I think though that like what you said, again, I think supports the idea of like more deep collaboration between Microsoft and CrowdStrike. I mean, that's how they can get in front of this. And the thing is that like Microsoft, like I said, because they're kind of in a penalty box too, because of this, like, I was talking to a CISO of a major agency, and he said that he would not be surprised if in like a couple of weeks, it ends up being like, oh, this was a Microsoft issue, right? Where, Microsoft is fully blamed, for this. And so I think in that environment, again, ultimately that tells you that you're going to get deepening between Microsoft, or a deepening relationship between Microsoft and CrowdStrike to kind of assuage those fears from IT staff. From what I've heard, people have commented very positively on Kurtz and the CrowdStrike response. Yes, even the $10, gift card was something that I think people appreciated, right? Because this wasn't like a $10 gift card to the company; it was to the IT staff at companies. And so I think that's just something that is like, a token, a gesture of goodwill. Now, ultimately, CrowdStrike is a SaaS business, right? So it's like a majority of their revenues are already predetermined based upon their existing book of business. And because of how integrated CrowdStrike is, you can't, like you said, you can't just yank it out, and so because of that, you're not going to get like a material change to revenues, at least for like NTM, through the next 12 months. So if billings drops, could that, hurt revenue estimates in the future? Yeah, absolutely. And so that's definitely a risk. However, I think that, with what the market is pricing in right now, looks like a substantial reduction in revenue, where that would be like, I don't want to say revenues would be cut in half almost, but like probably a good 20 to 25%. Like that's the impact to estimate revisions, or like that's like what the market implied to estimate revisions would be. And so I think that is like massive and unlikely. I think like the maximum you would see is probably like a 5% delta to existing estimates on like a next fiscal year basis. But the company is still going to grow at, in solid double digits. So in that environment, I don't know. I feel like it's still really compelling. I would say that the catalyst would be their earnings event, this quarter, because I think what's going to happen is, if you remember like the Okta breach that happened recently too, you had that big, this, and again, this was not a breach, right? So it's like you actually didn't like lose customer data, or you didn't like, get like secrets that were like stolen. You just had an issue where an upgrade, brought everyone down. So, well, I agree with you that it's a bad look and could potentially like push out, maybe the signing dates because people want additional concessions. Like I think that's the real thing here, that you're going to see like bigger concessions. That to me would be a reflection of like, that'll impact billings by say like 20%. Next year's billings by 20%, but that only ends up being like a 5 to 8% impact to revenues. So, and then I think that revenues from there will reaccelerate, and that the billings impact is really going to be like over the next 2 quarters. So once people like Okta, like people have already forgotten about the Okta breach, and so I think that that's something to just kind of keep in mind, that you're going to get like I think a reversion back to, maybe not back to like the multiple that we were trading, maybe not like 20 times EV to sales, but we'll probably get closer to 18 times. I think that sounds pretty reasonable, or at least get back to 15 times next year's sales. We're at 11 right now, so like we're at like a massive discount to that number right now, which is why I think it's like pretty attractive. Now, when would be like the time to get in? Well, CrowdStrike, they have their earnings are for another, it's going to be at the end of August, right? So we still have a month to go before we really would want to get in. I would expect that you start to see a pickup in CrowdStrike usually 2 weeks before earnings is typically when you get your earnings previews in, and so in that time is normally where you'd see maybe like start to see like a little bit of a pickup in the share, of the company, or you'd see like you start to see more of the positioning, and like on the options market. I think for now, I think we're already. I'm just double checking right now. Yeah, I think it already does look pretty good. Like for example, even though the implied, like across the board, the implied vol skew has like rotated, right? So it was like put side last week, and now it's shifted where it's like call side that's driving, so the smile is kind of flattening a little, but it's being lifted up by like out of the money calls. So I think that I think that's the right perspective. I agree with the positioning in the options market there, and I think that's probably the trade to make. Catalyst again would be the 30th. We have a couple of companies that report before then in security, and so we'll get important read-throughs as to whether or not there is, a flight of customers, because that's always a risk. I don't want to deny it, but we'll know a little bit more about that dynamic, as we get closer to the date. But I would expect that 2 weeks before, you're going to see sell side notes come out, and that's gonna, I think it's going to be pretty positive. So hard to, I wouldn't, I for sure would not short the stock, and I would actually be quite bullish on the name. So that's my view.
Yeah, I think, to be clear, I was really aligned to that. I was just saying that, I'll tell you how I tried to model too. I'm not going to go into that kind of detail, but based on previous experience, I know that like in situations like this, in a company like CrowdStrike, to get their revenue target, they basically need a funnel, that's like 7 to 10 times, maybe even a little larger, the size of their target, for the quarter. And I don't have any visibility, of course, into what their actual funnel conversion rates are at each sort of stage in their funnel. But just based on previous experience and kind of what I know of the industry, I'm going to guess that when they're, the average company like is getting maybe 30% of their deals done, but CrowdStrike, because it's such a good product, is probably north of that. So like 45% of their, their target close. So I modeled that, and then I backed out like, well, what if 30% of the funnel disappeared? Like it doesn't, like, again, it's not gone forever. It's just gone for the next quarter maybe, or like, until the end of the year, right? When the customer can apply maximum pricing pressure. And so when I backed all that out, it was like a 10% hit to earnings, and that might be, 10% hit to revenue. Now that might be, I'd fiddled with like adding renewals and stuff that might also get hung in that pipeline too. So that's probably, listening to you talk about it, it's probably, maybe I'm too aggressive in my estimate of like the impact to the funnel, but that's how I went about it, right, to kind of get to that figure. But you said 8 to 10%, which I think is, it's in the ballpark, right? And when I back that out to a price target, I got to, I just had it. Oh yeah, 323, and on a range of 216 to 341, right? So I'm inclined to buy it. I just didn't know when. And right now, like, the momentum is so bad in it, it didn't make sense to me to get into it yet. Because I think once it starts going up, it's going to go up for a while, right up in the earnings and beyond. You think that's right?
The thing that I would look at is, you're going to get all the volume when there's that big dislocation, right? And then once that dislocation is over, then you'll probably see like a drop in the volume. And so that's kind of what we're seeing. So like today, we were 30% under 10-day AVAT, for example. So we were marginally above, say, 20-day AVAT. So again, like, excluding the impact of, what was happening the news that came out last week or over the weekend. It's still a little more elevated, but I would assume that like most of the decisions to sell probably have already kind of cleared.
Yeah.
The kind of post information drift normally happens within the first 3 days. And the reason, and what you really need to, the way to like model this in is you say, okay, well, what is my, what's the ADV, and typically ADV is about, for CrowdStrike, it's around like 4.5 million shares that, that are transacted every day. And so in that environment of 4.6 million, if I had, if everyone was like long the name, and if I look at the owners of the security, I can see that like the vast majority of them are like long only hedge or like long only funds, or the like, like index funds. So the hedge fund positioning is going to be maybe like 5%. Okay, so like 5% of the amount of shares are say like hedge fund, like held by hedge funds. So in that environment, if it's like say 5%, well, that would be, and the amount of shares outstanding is around 98 million. So in that scenario, I just take 5% times 98 million. That's roughly 5 million shares. So it would take, roughly like one day if every hedge fund went short or like closed their position, it would take one day and it would be kind of chunky, right? Now, obviously, there's not going to be enough liquidity for people to do that. So they're going to like stage it. They're going to try to route it and like reduce the impact of that trade. But again, when everyone is exiting at the same time, it still happens anyway. So you would just take this and you would say, okay, well, assume that hedge funds want to be 10%. Like they don't want to be more than 10% of the daily volume. If the average volume is 4.6 million, then 10% of the volume is 460K shares. So how long would it take for them to get out of 5 million shares? Okay, about 10 days. Okay, so that kind of tells you like what you would look for. Now, how many shares actually transacted? You had like a massive spike in volume. I think it's still reasonable to expect that it would, so instead of it taking them 10 days, they're probably going to get them like between 3 and 5 days. And if you look at like the academic research on this, you find that, post announcement drift, pretty much post any announcement, the window is really like that 3 to 5 day period.
Mm-hmm.
Like that's where most of the action has, because people are very aggressive in closing out positions. People, in the old days, like you would really have to wait, and then nowadays the idea is like, no, you just want to like exit the position as soon as you possibly can. And so this means that window is there. Now, depending on where you think revisions are going to go, right? So if like, okay, bad news came out, but if you thought that like, oh, actually, like this really does put a big, this does totally, this kills the business, then it doesn't matter if it's down 30% over 3 days, because you expect that it's going to go to zero, right? So in that scenario, yeah, you could still go short, but you would know that there might be like a little bit of bounce back after like 3 to 5 days. So after about a week, there'd be a little bit of bounce back. So you might wait for that to happen before you start putting on your short position. But if you have conviction in your trade, then like my view is, and this is pretty much, people don't try to play around with it that much. Like you really want to make sure that you're positioned the way you want to be positioned, right? If you try to get too clever about your positioning, then you just miss your opportunities, right? So what will happen is people will start adding the position now, and then they'll scale into it as they kind of get to their catalysts, or as they get into like the kind of like positioning sweet spot. So if you did your work today on the name and you're like, oh, I want to be short because this company's going to go to zero, yeah, you for sure would open a position probably about, maybe like a 1% position. And you would expect that you would probably build that up to like an 8% position, over time. So that's kind of, how you would do it. Now, the tricky thing about when you go short is that, remember, that everything works on the flip side. So as your trade works for you, the position actually gets smaller, right, on your book.
Right.
And so that's like you slowly begin to like, sell more shares, and that always ends up being a potential risk. So you'll often have like at the like date of the trade, you'll say, okay, well, how many shares would I be max short at like the current price? And that'll typically be like your soft limit of how many shares you want to be short, because you don't want to inadvertently like end up being like, a bigger percentage of float. Right, because then you start running into liquidity issues, like GameStop. So, yeah, if you had a conviction around this, you would start the position. But typically, I don't want to say this is a hard and fast rule, but a good heuristic is that no fund wants to be more than, typically you don't want to be more than 10% of the daily volume. And so if you think about like a normal hedge fund, which is like, say like a normal PM, I don't say a hedge fund, say an average like equity long short, PM, probably running a book of like 250 million, and it's probably gross, so like 4x that, right? So they're running about $1 billion. So 1% position on $1 billion, that's 10 million, right? So you take that divided by the amount of the price of the shares, and you'll see like, okay, that's that would be the incremental purchase that they would have for every 1% weight that they shift to. And so then you could say, well, how long would it take them to get into the position? If that amount is like, 800,000 shares, and you know that your 10% of your ADV is 460,000, they know that it would take a fund manager 2 days to get into that 1% weight, on average, So that's like a good kind of like, rule of thumb. But again, you don't want to get too fancy with this because you can get left, in the dust. So you always want to make sure that your book is reflecting your views kind of all the time. And then, you can kind of wiggle around with it.
Well, in that case, I got a lot of stuff to put on tomorrow. One thing I think that I do a little bit different is I'm always looking at momentum and trying to trade around and then structure around it. So, I would feel under normal circumstances like it'd be very early getting into most of these because they haven't started to flip just yet. But I was feeling more comfortable about doing that with the others. Google, Microsoft, Amazon started to build positions in probably tomorrow.
So on the momentum front, right? Like for hedge funds, everyone hates momentum. So because and let me be clear, right? So there's like different types of momentum, right? Depends on like the time period, right? But there's something called short-term reversal factor, which is the last 20 days. Okay. And normally about the midpoint of the last 20 days is where things start to reflect. So you could almost say that the last 20 days, it's a martingale. It's like a coin flip. Okay. So that means that if the stock is up over the past 10 days, over the next 10 days, it's probably going to be down, so that over a 20-day period, it's roughly flat, or roughly where it would be relative to like its estimate revision. So like you would adjust for those things. You would say, but you would expect that like, so say on average that, the market is expected to go 8% this year. So on a monthly basis, that would be like slightly under 1%, right? Say like 0.85% per month. And then for every week, divide that by 4, right? And that's going to be like 22 basis points or 21 basis points, every week, right? So you could just say, okay, the stock has a beta of 1, so it should roughly track that. Okay, it should go up 20 basis points every week. And then you can say, well, the estimate revisions for the stock are increasing; they're accelerating relative to the benchmark. So in that case, you would lift your expectation of where the growth would be. Now, if the stock dramatically outperforms that, then you're really worried of short-term, reversal, right? If it's like within a certain standard deviation, then it's not a big deal. Hard to, fit around that. But you definitely want to avoid short-term reversal. So what I would say is that you actually want to buy, like if the stock is down on the last 20 days, but it's up over the last 6 months, like that's a good, like, if your fundamental thesis is intact, like that's telling you, okay, the stock is experiencing short-term reversal, good time to buy.
Yeah, and that's by the way, that's exactly what I'm doing for the most part. There's a little more sophistication to it, just looking at how things are moving around, what I consider to be their equilibrium prices. But yeah, and actually, the other interesting thing that you said is that that 20-day horizon is really important. And so, my most of my trades are within 20 days. I seldom have a position on longer than 20 days.
Nice. So one of the things that I look for, which is like, how can I see where we're gonna like bottom at, is I'll just take a look at the option positioning. Like that's like a quick and easy way, right? So if I look at, like Friday, there's a lot of interest, all of the big volume, that happened, looks like it was the 270 call. Okay, so it looks like people are already starting to get more bullish, on the name. Now, I also see that there is it looks like a seagull. It's like a 255 put, 250 put, and a 265 call. That looks like it's like the same trade because the lots are all somewhat similar, or maybe the put spread is. And so you'll see like a big trade like that, and then like, normally what I'll do is I'll talk to like my sales traders. I'm like, hey guys, like, you guys know what side this was on? It was just like, was this a buy or a sell, right? But normally, like you will know because you'll know what the thesis is. Like you'll know what's going on with the stock, right? Another way that you could do it is you could say, well, what was the price around the time? And if it was like bid side or if it was ask side, it can also tell you if it was which side they're on. That's a little looser, but you could do that. So you see a trade like this and like, okay, well, people are already putting in trades, and like the position is like that 270 call. That's like it was 10,000 lots. So it's a lot. It's a pretty big size.
Yeah.
That's a legit trade. And that's expiring tomorrow. So, and if you look further out to say Augie regulars, looks like the big volume is 300 calls. There's a put spread, 240 and 250 put spread, and then a few others. Maybe it's a put spread with a call. So that might be a Siegel too. I don't know. I would have to build it to comment. But yeah, you could look to see like, okay, what's like happening on positioning. When I see like how people are, so what I actually like to do is I'll go back to a certain contract, like say like August regulars, and I want to actually see what the open interest was, ideally like on the day before, because that'll tell me where there will be like a delta like crush to. And then, but then of course it depends on like how people will update their views, right? So if people are still negative on the stock, obviously they can start to bid down strike. Now, if they're bullish on the stock, they'll bid up strike. So you get that dynamic that's involved. But that'll help you like understand like, okay, where's the price going to go? And then once price hits that, or once price gets really close to it, then you know that like, okay, there's no longer that structural demand on it or that structural supply. So I'm going to buy around there. It doesn't matter if it happens today or tomorrow or in a week, but you know that that's like a position there. Now, one thing obviously is the impact of the options market is greater the closer you are to the expiration date, right? So you always want to like take a look at those, but sometimes there's just not a lot of interest on those series. So you may just want to look at the regulars, but I'll kind of go through them. And again, it's a little bit of an art in the sense that like you gotta like go and look through these different series, but as long as you take it with a grain of salt, it can help you kind of triangulate like where you think the price is going to go in the near term, given where the positioning is on the stock. And that's if you have that in mind, like, okay, this is what positioning is. Everyone is positioned for like 250 on the put. What does a 250 mean? Well, if I shift my revisions to get lower, and then maybe my multiple gets lower too because my long-term growth gets impacted. Okay, what does that imply? And then you can make a bet. You can say, well, that's telling me that the market would then be expecting a really low growth rate, or maybe like a subtraction to growth over the next 2 years, and I think that's unlikely, or I think that's likely. So at the end of the day, you still have to have the fundamental thesis like front and center, but this is what you want to use. Positioning is what you're going to want to use to understand like what are the prices. Like, for example, if I know that the different scenarios out there would imply a stock of $400, 320, or 220, right? And then I see clusters of options around those three strikes. Like that's what you normally would want to see. Like you typically would be able to kind of see that happen, and that's the useful element for you. Now, if everyone is crowding on, you see that open interest and volumes of like picked up a lot for one of the series, then you know that okay, it seems like maybe that thesis is what's tracking or catching on, and then you would want to corroborate that to your own work and say like, oh yeah, is that the case? But if you don't see it, then obviously you don't want to fade it. So again, it really I can't stress how important it is to have your own view, but you can then use the positioning information to help you understand how maybe the market is positioned for this. And the way that like we like to see this is that the price is going to settle in between the two major strikes, and that's where price is going to go, right? And it will lean towards like the heavier strike, in a vacuum, right? In a vacuum, the marginal flow to whatever strike is going to lift, where the delta hedging is going to take place. So that's kind of like the way that we see it.
Do you pay attention to term structure and skew?
Yeah, I look at skew because skew tells me like what side is being bid, right? And if it's call side being bid, then and ultimately like, that should track with your view. Like I use like if I see momentum in implied volatility, so like implied volatility, the structure is rising, um, then that tells me that there's a lot of positioning, a lot of positive positioning. And that can be a sign of crowding, or it can also be a leading indicator of a beat. Yeah, so that's kind of the way that it is. I mean, the way that I use it is it's a leading indicator that people are betting on a beat, right? If everyone is betting on a beat and the company comes in line, there's going to be lots of supply, overnight or the next day, right? So it can tell me a lot about how the stock is going to trade post the catalyst.
Yeah, I look at skew a lot at volatility term structure as well, especially obviously around events. Looking at CrowdStrike right now, the skew is actually backwarded from current strike up to about 280 or so on the call side. So it seems like there's a lot of put buying still happening, or has recently happened. But I haven't been watching this curve, so I don't know how it's shifted, and I don't have particularly good analytics for tracking the shifts in skew.
So IB, who I'm actually going to be leaving, they have a decent, like it's kind of, it's one of those like, it's not the nicest looking tool, but it's like a decent, like it does the job, and it does track the time lapse skew, and so that can be helpful because I can see that, like for example, that today implied vol is lower than it was yesterday, and the whole skew structure has shifted from where it was last week. So, for example, last week, like put side was trading at 120, implied vol, and then today put side is trading at like, and this is for Augie regulars. Now put side is trading at like 88 implied vol, like roughly, Last week implied vol on a 325 strike was 40%. Today, it's trading at about 50%. Okay, so that tells me that like there's a shift in the term structure where now people are kind of like, okay, the move has happened, and now they're allocating or like actually bidding up on the up strike for calls. That's like the view there. That's an assumption that the higher strikes are led by calls. Because the move has already happened. Sometimes if the move hasn't happened, then people might be short puts, or buying puts, up strike. But typically after like a big move happens, it's actually it's more like indicative of like the actual positioning on whether you're on the call or. So yeah, stuff like that is like, how much is that going to like change it doesn't change my view. It just helps me understand like what other people are doing. And so if I have a view that, CrowdStrike is going to do amazing, they're going to do fantastic, and then I'm going to start to buy the stock, right? But how aggressively am I going to buy the stock? Well, if I'm seeing that like not a lot of people are buying the stock yet, stock is still going down a little, right? Like positioning is pretty weak, then I'm going to buy slow. I can be very patient. But if I'm starting to see that like people are like trying to get into the name, then I'm going to be more aggressive and try to like, buy into my position as soon as possible. Now, the thing is that you have to tie in that positioning with like what you think the next incremental information is going to be. So we have, Microsoft earnings, right? That's going to be incremental for CrowdStrike because they're going to talk about the outage. And then we're going to have some other companies that are going to report, right? And then when we hear more about when we get more color about what's happening with hyperscalers, and more color about what's happening with cybersecurity companies, CyberArk is going to report, in a couple of weeks. that's going to give us also some additional color as to like what's happening. These are all things that are going to be incremental. And so, for example, if I saw a surge in like call buying, but I didn't think that there was going to be something incremental that was going to happen like next week, or I thought that the incremental was going to be bad, then I'm going to wait actually, because I'm going to like, oh, those guys are going to realize that trade didn't work out for them, and it's I'm going to be better positioned to wait. This is exactly kind of what our view was with Tesla, because and Andy can speak more about this, but with Tesla, you had them come out with this robo-taxi event, and so everyone started to like bid up the stock. I mean, there were a couple of dynamics involved, right? One was just like an improving backdrop for EVs. That was an important driver. But the next one was, this like potential really positive catalyst for robotaxi business, right? And then we did the math and we're like, well, what would this actually impact? What would the impact be? And it'd be like, okay, a $40 tailwind, over the next 2 years. Should that move the stock price that much? No, it shouldn't, right? And so it kind of tells you like, okay, well, in this case, like I want to be a little short. Everyone is long into this, and they're going to be disappointed. So that's like the great setup on the trade. Even if fundamentally we're like, I think Tesla's their production is probably going to improve over the next couple of years because their EVs are back on track. I still know that the expectations for the catalyst are too high, and so that is the signal to like trade. Is it like perfect timing? No, it's not. And I think that searching for the perfect timing, like that's if you look at a chart, don't look at the price chart, because the problem with the price chart is that like the highest price and the lowest price, the volume is probably one. It was like one share might have crossed at that price.
Right.
So look at like a VWAP or something, because that gives you a more realistic take on like where price actually was. And but even then, I would say like don't worry about the chart. Like worry, like we want to focus on the good decision. You know what they say that and you're a professional poker player. In poker, and you can tell this to me because I'm not that good at poker. But it's that the best game is played when even if you knew all the cards on the table, you still wouldn't change what you did, right? That's how you want to be, And obviously, it's like for the information that you have at the time, you don't want to change your view, right? So if no information has changed, don't change your view. Don't worry about the price. Think about the information, and when you focus on that, you're more centered on what's actually going to matter for the stock.
Yeah, totally agree.
There's a lot more in common between poker and trading than most people would like to admit. But really similar games, right? Decision making under uncertainty. A lot of similarity.
Yeah, exactly.
Like managing the book, right? Deep stack versus like shallow.
Yeah, and I think that the only way to do this and still be sane is we have to just acknowledge that we're not going to get things right all the time. We're going to have periods of underperformance. There's many times where we can underperform for reasons that we miss, and that's what we can actually get better at. But we can't control the things that we can't miss. Like I'll give you a good example. This month, I've been slamming my book on the table saying, equities are going to be really weak this month, right? Fade the surge in equities. And, is my P&L up like crazy this month? No, it's not. And part of it is because there's this factor rotation that's happening where companies that actually are, let's just say that their performance has suffering, are actually outperforming. So my long short book, right, like my shorts are rallying faster than my longs are moving. And that has definitely been a headwind. So, one thing that I want to, make clear is that you can be as smart as you want and look at every, little nuance in detail. And there's still going to be things that, you're going to miss that you have to wait for. And so for me, it's like I have this view of what I think is going to happen with like the Russell 2000 and these, I don't want to call them junk stocks, but let's call them more like cyclical. or higher beta. And my view is these guys, it's going to get hurt post FOMC. Now, the sad thing is that, I have to wait after July to kind of monetize this trade. So it's like, through the period, can I survive? Like that becomes another thing, to think about. And that's where managing the size of the book matters. So like, I've had to, I wouldn't call it degrowth, but I've had to like reduce my growth through time because I have to wait for this trade to work out, in my favor. And then as we get closer to the catalyst, like within more days, I'll probably lift my growth again. But this is how you try to manage through situations like this. So, it's always going to be, the market loves to, throw things at you. I think like what we have to try our best at is decompose price, because price by itself isn't going to teach us that much. We have to actually focus on the things that are learnable, the skills that we can actually learn. And that's going to be things around like, okay, there is incremental information out there. Like we need to make sure that we're tracking all the incremental information, right? Like we can actually do that. Or, we can update our estimates. We can, review positioning. We can do all these things. Those are things that we can kind of incorporate in our process. And, the result should be that we have higher P&L, right? Like, my realized Sharp is, say a 2. And that is evidence of my skill. It's not like my day's P&L, right? So day's P&L is going to be messy. Month's P&L, okay. Quarterly P&L, okay. 1 year is what really matters. And then also, your over time, you have your 5-year, your 10-year. Then you want to look at what your Sharp ratio has been, and that, like, you want to see that number over time. And so I would say when you it's obviously it's super hard because like I feel, I sweat when I have a down day and I'm like, oh my God, like what's happening, right? But you just have to like separate yourself from that emotion and focus on, okay, how do I feel about my book? Am I worried about my book just because stock prices are down? Or am I worried about my book because like I feel that my thesis is not fully baked? And that tells me what I need to focus on. If I have a trade that's going against me, but my thesis is strong, then I have good conviction. I'm going to stick with it. And I've had, but trust me, I've had plenty of times where I was short. This happens more times on the short side because it's more risky because you're short, right? Where I've cut positions because the price moved against me, even though like my conviction and my thesis I thought was like, on track. But you're gonna have situations like that. That's okay. You just have to focus on like moving on and then just making sure that you have the idea of velocity to move on to the next position, the next trade. Right? That's kind of the thing that I think I always emphasize on. And it's always fine to like not make the trade. Like we have the opportunity because we're on the buy side. We can just choose not to make a trade. So that's another important, aspect to keep in mind as well.
I'll just echo that and say, I started trading in 1998 badly, and I started playing cards, I think, around 2003. And I'd like to say I've experienced every kind of variance you can have. Been multi-millionaire, and I've been living broke in my car on the beach in Santa Cruz. So I've definitely experienced all the variance. But I think now, as an old man, I'm for one thing in this game, I always have on defined risk structure, and I have absolute delta equivalent risk limits per position and per industry, per sector, et cetera, right? And very careful hedging of top line factor exposures. And so I sleep like a baby, quite honestly. I don't sweat it one bit because I always know what I'm in for, and every bit I've got into this is risk capital anyway. So, but that's what changed my professional poker game is I kept trying to play at stakes I could scarcely afford as fast as possible, So I was over leveraged in poker, and over leveraged in the market the way I used to trade as well. So, by the way, Wahdy, I mean, when large institutions and hedge funds are trading options, Are they typically just trading vanilla call put structure? Like, I mean, do they put on spreads? What's the most common? It's the most common structure that you see on the institutional side.
I'm sure Andy has some takes on this too. I think it just depends on the sort of hedge fund. Like I remember that you could have there are hedge funds that are like vol traders, and these guys are almost like market makers to some degree.
Yeah.
They're like a step removed, and so they had very complicated option trades. Like there were things like jelly rolls or like weird structures that we'd have to throw on. And these are like trades that take advantage of like time mark, for example. Like it's super.
Yeah.
Super
No, I mean for like long short books because yeah, I mean I was doing vol arb stuff, in 2008, 2007, 2006, but those are very complicated books to manage. Like just almost not worth it complicated. In fact, nowadays definitely not worth it complicated, right?
Yeah.
But just vanilla long short stuff. I'm just curious about how others are managing their leverage and are they looking at like delta equivalent risk? Are they throwing on are they trying to reduce costs in the structure? Like do they take advantage of skew? I wonder these things like if I'm the only one, or if people just get in there and start buying calls when it's ready for it to go up.
So I think generally speaking, when you're like a normal hedge fund of like say 250 million, say roughly, or say like an equity PM, so between 100 and 250 million, right? I mean, you can't really put on massive positions, in options, right? Like the display liquidity is very low, so you're gonna call, you would have called Andy, you would have called me, and you would have said, hey, like, give me a bid on 10,000 contracts of X, Y, and Z. Like this is the trade that I want, it's call spread, blah blah blah. Generally, so generally speaking, it's going to be pretty well aligned with your delta. But what you have to understand is that all of these people, I'm going to say like the vast majority of these PMs, at least the PMs that are like serious about it, they're going to look at their book on a beta adjusted basis. Okay, and they're going to analyze not just the beta, but also the factor risk. Like I'm constantly looking at, like every day, like I'm checking what my factor exposures look like, and if I'm over levered or if I'm overexposed, then I need to trim that risk. Doesn't really matter. So even if I throw an option position on, like in my spreadsheet, I calculate, the deltas and the betas, and then I'll calculate the beta adjusted impact of that position. So if I have if I already have a 5%, position on, then I add an option trade to it. It might lift my exposure to say 8%, and I might need to trim my stock position in order to carry that option position. That's so typically what's going to happen is because if you're a long short PM, you typically have a view on the underlying, and so the cheapest trade you can make is actually just buying the call outright. That's often just the cheapest way to do it. Because if you were to buy a call spread, then you're limiting your upside on a position where you think that your terminal value. So typically what's going to happen is there is a little bit of a strategy, and I'm going to call it the caveman style, okay? So caveman trading is where you will, and this is, I got to be careful with my verbiage here because it's not really market manipulation, but it can kind of sound like it. So what happens is I will go and I will like put in an order to buy my shares, and I'll go and I'll sweep screens or like buy a ton of call options too. And what happens is when I do that, I reduce supply of the shares available in spot. So whoever's delta hedging the shares, right, has to bid up price. And that can create a little bit of a momentum effect in the stock. Yeah. So this falls under broadly what's called quote unquote window dressing. It's a very aggressive style of trading. It doesn't really work in the long run. Like like it might work for like 1 week, but then the next week you go down because you have because of the risk that you took. Like you end up paying the transaction cost one way or another. So it's a very aggressive style. Again, I call that caveman. So like you could, for example, buy like I'll go buy like 10,000 shares or like 50,000 shares of stock, and go buy like 5,000 call options at the money, or even with the low delta, because if I sweep screens and then the stock price goes up by say 1 or 2%, right, then that's going to push the delta hedger to have to buy a lot more stock. So those are I don't want to call them games that are played, but it's a very aggressive type of trading. Now, one thing I'll tell you is that by and large, people that do this are considered super old school, and it's like it's kind of, I don't want to say like look down, but it's too much noise, because you then get stuck in this rat race where like, okay, maybe when you do that today, your P&L is slightly higher, but then tomorrow, right, everything gets adjusted. So tomorrow you're starting off already a little negative, and then you have to like you gotta keep just like engaging in things like that, and so it's kind of like looked down on, but I'm not going to say it doesn't happen. It for sure happens. The other thing that you could do is, so that's like caveman style, where caveman style is where you're like, you are the catalyst for momentum. Like you create the momentum in the stock, and that can really work, especially if the stock is pretty thinly traded. Then you for sure can, or if you know that like liquidity is pretty low on the name today, then you can have an impact on the name, and maybe you'll push it a little to make your, I don't know, your month end look good, or your quarter end look good. That was a very popular thing back in the day. The other style is if you have like a view, if you're gonna get into like a really big position, you're a really big fund, you're gonna get into a really big position. Then what you do is you start buying the stock and start buying it out of the money call at the same time. Okay. And you're going to make like so much money on that out of the money call that like, again, you're not going to want to, you don't want to like, you're not going to do a call spread. You're just going to like buy outright that out of the money call. So that is like caveman light. And I'd say like I'm going to say like I'll do that for sure. It's definitely something where, yeah, you can, because if I buy an out of the money call, the delta's low. So if I multiply the delta by the beta, right, then I have the impact to my position weighting is low. So I'm not going to like massively overextend my position by doing that. So it's kind of like a cheap way to get like access to gamma, like that upside. But then what happens is as the price moves up in my direction, I have to like sell positions. So like I'm like selling supply throughout the entire period, and then I might tie it off with like a collar at the end before like trying to figure out what to do next. So you could do things like that too. And then for things like call spreads or butterflies, you will have a little bit of that. It just depends on like the trade situation. What's more common is that depending on the event that you're trading, like the event that you're trading will dictate the kind of spread or strategy that you're going to utilize with an option. So for example, if you know that there's going to be like and this is not a good example, but just to kind of illustrate the point, if you know that there's going to be an acquisition of a company at say $40, it's currently trading at $38, right? You can pin the $40, right? So like you could do something like that, right? You can trade the vol, or you could trade the option structure for that the risk arb trade. So that's very popular to use options to make a risk arb trade. Another thing that you could do is you could create like a broken wing, butterfly, or like a certain ratio for a certain payoff that you think is really likely. Like for example, if you know that going into earnings, like say for CrowdStrike, you're bullish on the stock, but you also know that like positioning is really weak, and so that might push the stock up like massively higher, like over like a 1 or 2 day period, then you want to get upside to that, right? So what you might do is you might fund like a out of the money call by selling something in the money, like maybe like in the money, something like that. So you could do things like that as well to like sort of quote unquote get the price to even. But it just depends on the type of catalyst that you're trading, and yeah, it depends on the type of catalyst that you're trading, and then the kind of payoff that you typically want to get. Like I said though, typically on the long short side, the view is that you're the informed investor. So like you're the one that sets the price. You're the price setter. And in that case, you're the person that should be just long the call, or say long the stock. How popular is this? I think that it is. It depends. Nowadays, I'm going to say a significant majority of hedge fund managers or portfolio managers come from investment banking or equity research backgrounds. And so because of that, they have like more of like an MBA style of understanding of option structures. Whereas if you went through like the sales trading route, you'd have a deeper understanding of like market microstructure and positioning, related stuff. So I think that generally speaking, like caveman style or kind of protective, defensive styles, that those are, I would say most PMs will employ something along those lines. For more sophisticated stuff, it doesn't necessarily mean that they have sales trading experience. Normally I think, when I would talk to a guy who was trying to do something that was very complicated, it would just happen to be that was like the kind of structure that they were looking for, and I could double check myself and see that, okay, there's an upcoming catalyst, and that's the kind of payoff that they were looking for. Like I would always, I'm sure Andy sees it too, but I would always like try to replicate the trade if I had time and see what the payoff looked like. So that's kind of like the way that it is, on the buy side. So people will look at, like, if you're a PM, if you're not a vol trader, you're like a long short guy, you don't really care about skew. You don't really care about those things because you're the one that creates it. That makes sense. The guys that care about skew are typically like your market makers or your sell side traders. And the reason why is because they have to lay off risk. And so they need to know like how they need a position given where skew has been or what's happened to the curve. Does that answer your question?
Yeah, it was a good answer. And I think I got most of it, which is, right. For to summarize, mostly price insensitive relative to volatility, and moving fast and taking down everything you can, right? And that's totally different for me. I think because I'm just such a small fish in a big pond. Then I need to stack up every single edge that I can find, right? So things like, I don't know, for me, like vertical structure, when the skew is favorable, right? I mean, there can be a theoretical edge to that if your model, if your forecast is accurate, right? And if it's substantially different than
but here's the thing, right?
Distribution.
If you have an edge in the delta, then you want to be long asymmetry. So you don't want verticals. You don't want any sort of like, you need to like uncap your gains because that's what's going to save you. Like, if you're right 4 times out of 7 times and you get like massive returns on those 4 times, say like your average return might be like 400 or 500%, right, on those option structures. Why would you give that up for maybe a 25 to 50% return, profile on a call spread or put spread?
Yeah, I mean, good things can happen to you, right? But I guess think about the vertical structure is like you're typically, or I don't know, that's what I'm doing. I'm typically setting a price target, right, and then checking the distribution, right, to understand if the stock can even move where I think it can move at the time that I think it can move there. Right, so it's so exceedingly rare. And I'm saying, when I say vertical structure, I'm talking about like, the typical would be like, buy the 50, sell the 20, or buy the 30, sell the 10, right? And so at those moments, the moves are so large, right, that typically you're never seeing anything outside that. And there's some exceptions. And also, there's also ways to do this with like, calendarized ratio. So like take the situation where, let's say that it's Meta and you're going into earnings, a couple quarters ago. You could sell the at the monies. You buy the calendar, in other words, but on a ratio of say 2-to-1, and in that structure, you have unlimited upside. I mean, your structure along delta, so it looks just like a call. The difference is that you've got a carry built into your terminal event, right? So if when you know that the catalyst you're looking for is earnings, and you can pick the strike that's just beyond that event date, right, and actually capture some excess premium. So there's like structures like that are still unbounded, but are still, that's a calendar example, but you can also do the ratio calendar vertical. And I do that quite a bit, to create that same kind of basically long call profile, but to neutralize much of the theta, right, that I don't want to pay. And someone said to me the other day that the measure of a man was his willingness to pay theta. And I thought that was kind of funny for an options trade. Anyway,
so
yeah,
I'm just going to show you something. This is actually a tool that Interactive Brokers has that I think is actually quite a good tool. And it's not super. It's not.
Oh yeah, I know. I remember probability lab. Yeah, I was an IB customer also. Yeah.
So the thing about this is that what this tells you is that the market is wrong. So whatever the price it's giving you here, like this is absolutely wrong. Like this is going to be wrong. Okay. This just tells you that at today's price, given kind of what we know about the stock, or like what a market maker knows about the stock today to lay off their risk, this is the distribution profile that they want to have, okay? Because they're on the they're kind of sell side, okay? But we have a view. So our view might be that we think that actually it's going to it's going to look like this.
Right.
Okay.
Yep.
And so in that case, all of the Greeks or whatever that the market is currently putting into the option price is completely wrong. It's totally off. It has no benefit to us. The only benefit it has to us is that it can tell us that, well, the market's not positioning for what I think is going to happen. So all you really want to do is say, okay, well, if this is what the market is pricing in, but I have this view on where the delta is going to be, let me just price the option at that new delta. And if there's a difference, then that is how much I expect to make. That's like my P&L. But instead of even making it this complicated, you could already do that by just looking at like the structure. So say we go to this is August 16th, right? And so it's like, okay, well, I could do some fancy call spread, but instead I could say, well, if I think that the stock is going to hit 325, like I think that's my view. That stock is actually worth 325. That's the day. Like, why do I think that the stock is going to go to 325 after earnings? Well, it's because actually, by the way, it would have to be September. So it would actually be September 6th or September 20th. You can see which one had more positioning. So this seems to be the actively traded contract. So in this case, I can say, okay, well, I think the stock is going to go to like say 320 by September 20th. And why is that going to happen? It's going to happen because on the 30th is earnings, and if the stock is currently pricing the company as if it's going to only do $20 in revenue, but actually, or in sales or in earnings, but actually after earnings, we're going to know that we're actually going to do $40 in earnings. So like that's the day that you're going to know that you're right or wrong, right? And so when I just price that in, I'm like, okay, the stock is going to be worth 320. How long will the market take? How efficient is the market to get to 320 from its current price? Well, post-earnings announcement shift is normally 3 to 7 days, right? Post-earnings announcement, it's a 1 week pretty much phenomena. So I think that'll take about a week. And if that's the case, where is what contract is going to be right for me? Maybe I do the September 6th, contract, and I buy, and I'm thinking that, okay, we're going to get to the 320. Now, how do I determine which trade to actually make? This is where you start looking at what's called gearing. Which strike is going to get you the highest P&L if it expires in the money by maturity? Okay, and so that's where it's like, okay, well, if I bought the 260 calls, and if I think I'm going to hit to 320, then that's going to be $60. So I'm going to make 3 times my money if I buy the call now. Okay, but what if I bought the 300 call? Well, that's going to go up by, say, 2.5 times. So I shouldn't buy the 300 call, right? The 260 call is actually getting me better gearing than the 300 call. So this is the kind of analysis that you would do to figure out which strike is more optimal given the payoff that you're looking for. And that's why you typically are not going to buy a strike that's out of or above your terminal. You're typically going to buy like around, probably a little bit below your terminal, because this is the price that you think it's going to hit. Yeah, obviously the stock might overextend, but you want to be safer than sorry. So you're probably going to do something that's that is going to be, if it expires in the money, you still make money off of it. Yeah. So that's that's kind of how we approach it.
Yeah, I mean you learn very early as an options trader not to buy strikes at your terminal value.
Right.
It doesn't work out well. But going back to the tool you were just showing on the probability lab, this is something I muddled over, I don't know, maybe 10 years ago, but Black-Scholes has this risk neutrality assumption baked in, right? So the drift component of that is rho, the risk-free rate. And, that's what tweak here, tweak there. That's more or less what market makers do all the time, right? There are other pricing models, though, that you can use to muck with drift. If you have a specific moment, specific place on the distribution that you think, you drew a peak, you slid a peak in there somewhere earlier that was off of this normalish looking distribution here. But there's a lot of them. There's the Heston model, right? There's jump diffusion stuff. People have done Garch, to try to, which I think is crazily complicated to try to do this stuff. But yeah, so if you have a different assumption like you're drawing there, right? You can actually kind of manhandle, so to speak, Black-Scholes, and also figure out what pricings and terminal values those options should be under those assumptions on average, right? Which is kind of useful to know. But I stopped doing that because I realized, typically with the typical shape of the skew, in a typical earnings event, right, you can have a really flat, you're gonna have a backwarded volatility surface and a really flat looking skew until you get out into the tails, right? So in that environment, you can just get long, at no cost or sometimes at a slight edge by being in the 50-20 vertical. And that's going to neutralize theta and Vega and give you a nice risk reward profile generally. Or if you're really, like in the case of CrowdStrike, let's take that example, right? Like in that case, the stock could go up quite a bit, right? So maybe take the 30-10 instead, because the odds of it going beyond that, beyond 10 delta, like in this situation, to me, are almost nil. Right? So there's no value to being long that tail to the upside. There's always value in being long tails to the downside, however, right? So, and we, I think we were chatting the other day, Mo, about this, just that the holy grail, right, is to find at least a break even tail hedge, right, where the cost of tail hedging is just basically free. And I have a theory that we should whiteboard maybe about this, and in particular in dealing with a book of vertical structure like this, when you're hedging the residual tail, off the correlated book, right, off the beta weighted Greeks, in the left hand tail, that might be almost free. Like when I simulate it, I have some pretty good Python-based, option simulation crap I wrote a long time ago over here. And as long as you're monetizing the tail hedge, all the time, basically, then it's just under like free. There's a slight cost to it. I haven't backed in, all the trading costs and slippage and everything to it, but so I know there's going to be a negative value there, but compared to just like, I don't know, because there's all these there's all these like tail risk hedging funds and stuff now, or guys that are trying to be systematically long vol at, one delta and, plowing, I guess, because of the, the Empirica stuff, right? Like, plowing 2% of NAV into just being long the tail or something. That just seems crazy. It seems crazy to me that no one does it. And I guess maybe add some insight on this. Like it must just be a cost thing, in the institutional world, that it's too difficult and too expensive, or at least historically it was, right? For hedge funds to do it, right?
So what I wanted to show here was that you can mimic the profile of this custom probability distribution using a ratio spread.
Yeah.
Right.
Yeah.
So I think like that's probably the way that you'd want to do it, right? Because then you can make downside almost free. You could get to some point, and then you could have some, great upside. But you just want to compare the payoff to that versus if you just bought the call. Like if I just bought 100, calls, and if I'm right, I'm going to make like 30 grand. And in this structure, it's going to cost me like $5,000 to put on the ratio spread. And if I'm right, I'm going to make $8,000. Like those are the things that you want to think about, because at the end of the day, and this is kind of like just, based upon like my limited experience, but like when I, worked or whatever, but like this trade, for example, this is a call spread, or this is a ratio spread on CrowdStrike. Actually, let me make this the 350.
Sometimes, depending on what the
yeah, you could make like $5,000 on this trade, and it costs you $39 to put on, right?
Yeah,
that's a pretty good payoff.
Yeah, it's just the tail on it, right? But in certain situations like this CrowdStrike thing, like you kind of know what the tail is, right? There's very, very infinitesimally small things that could drive that higher. A lot of times, though, you can put on a very similar looking structure that's calendarized, and it'll be almost free at one point on the curve or the other, depending on which way you're trying to get, depending on the shape of the skew too, of course. And the term structure vol, it's they're more complicated to manage at a book level, but they're defined risk. So, again, you sleep well in it, and a lot cheaper, than like putting on a mini-legged butterfly or something. There's 2 legs, right? Anyway, I want to look at some of that stuff with you next time you sit down in San Francisco.
Yeah, I think at the end of the day, it's like we want to. At the end of the day, like we have to focus on like where we're going to get our edge from, right? And it's like I know that I'm going to get my edge from the delta, like where I think earnings are going to be, how this is going to translate into the price. Then by definition, like I probably don't have the manpower or the ability to also have an edge in what's happening in the vol space. So at the end of the day, it's just going to boil down to which is the best trade to get me the kind of gearing profile that I want for the trade that I think is going to happen, for what I think is going to happen. And it doesn't mean that you're price insensitive fully, because but it does mean that you use price to tell you how rich or cheap that trade is. And when that trade is cheap, obviously you may go bigger, right? And if the trade is expensive, you may go smaller. But that's just kind of the dynamic that I think is it's more useful, because otherwise we start going down these rabbit holes of trying to build like the best structure. But the problem is that like you can only, we all have like limited, headspace, right? So it's like we have to figure out where we're going to get our edge from, and then like double down on that part, and then use options for the gearing. So like when I'm analyzing like an option contract, it's usually going to be like less than a 5-minute thing, that I'm going to check. I'm just going to see, hey, could I put on an option trade here, and would it make sense, and is it going to pay me, right? And then what is the impact of this option position to my gross and my net exposure? Does this lift my net exposure? Am I now factor skewed? Like what's going to happen there? And then you manage it. So that's kind of the way that I approach it. I'm not saying that it's the perfect way, but what I will say though is that because our job, right, when we're trading, and this as much more than I do, which is that there's every day is a little different, right? You are constantly, what does Mike Tyson say? Everyone has a plan to get punched in the face. So you're gonna get punched in the face constantly, and even if you have defined risk, like you get sequential losses because maybe you didn't have the time to analyze the delta correctly, right? So these are the things where it's like we have to figure out, okay, like what is the way that I like to see it is like we're like a Michelin-starred kitchen, and in that case you set your menu and then you just have to execute it with laser focus through the day. And then the next day or the next week, you change your menu, and then you go through the same process over and over again. But you don't want to, if you're a Michelin-starred, chef, and you traditionally have a background in French cuisine, like that is not the time or place to experiment with like Indian food, right? Because you're just not gonna do it that well, and you might lose a star. So that's the way that I see it.
And I love that analogy, by the way. And I guess like, for me, coming from like, the Vol side, like I have a Michelin starred kitchen on the Vol side. And, 4 months ago, I had a lemonade stand on Idio, right? Like, I mean, that's for, the level of sophistication. Now, in the last months, I've built a lot of infrastructure, and I'm just getting good at the process and going through, and thanks to you, by the way, for constantly sharing with me and teaching. You're a good coach, man. It's almost like you should coach for a living. Coach this stuff for a living.
I feel like I am. I'm not sure if I'm a good coach, but I feel like I can empathize it because I'm sitting through it too, And I feel like I learned from you guys just as much as it goes both ways, really, because like you've been in the seat before, like you've ran money and you still run money, even if it's for yourself, but so you know what it's like, and that definitely helps me. But even if it's like someone like, like Andy, who is a younger professional, right? I mean, he has a lot of experiences or perspectives that, adds to it as well. So I see this as very mutually beneficial. I don't really see myself as a coach as much as I feel like I'm like a, the sous chef or chef de cuisine kind of a thing. But I'm constantly learning too. So it like speeds up my learning to have, other people who are meticulous and professional and go into the weeds. That's super helpful for me as well.
I'm peeling potatoes and chopping onions. But yeah, like going back to that option, I certainly agree that caveman thinking doesn't work because on the sell side you can actually see them hit the tape.
Yeah.
So it's like, okay, you have that position on, in the FX side, especially in the dollar Argentina, and then you are come and ask for the option price, and then sometimes like exotic stuff, like we know, and then we're gonna make the price so large or like so wide that you're not gonna make any profit. But on, from my experience at City side, most of my clients, the long short side, did delta neutral option trade. Doesn't matter the structure, vertical, butterfly, or like straddle, whatever. Most of them are delta neutral, and that's just, I guess, just a small selection of West Coast fund. That's how they run. I don't normally see vanilla calls or vanilla puts.
So these are like Maybe these are vol traders then. They were just trying to be longer.
Maybe these are more vol traders. They're more trading on the Vega side.
Well, and another thing that you can do is you can use a vertical to kind of lift your buying power, or you can a lot of times people will use options to kind of allow them to take on more risk, in a way that's like not going to impact their net exposure, because everyone is like for example, if I there's a couple of trades you can put on to take a view of risk, right? That is not going to increase my risk limits, and those are definitely going to be verticals, but it'll depend. It'll depend on like what you're trying to do. Often there's an approach which is, if you can find like one thing or two things that can give you like some sort of a very consistent payoff, you will do that in like massive size and use that to like buttress your kind of delta exposure risks as well. And so, if you have, for example, if you have there's like 4 or 5 stocks that you have like a very concrete view on, and maybe the market is pricing the